Welcome back to the channel. We're continuing our audiobook journey through Technical Analysis Explained, picking up right after Chapter 12. In the next section of the book, the focus shifts towards some of the most practical and widely used tools in market analysis, momentum indicators, charting techniques, and the art of combining signals into a complete trading picture. As we move forward, here's a quick overview of what the upcoming chapters will cover. Chapter 13, Momentum 1, Basic Principles. Introducing the foundational ideas behind momentum, why it matters, and how traders use it to measure the strength of price movement. Chapter 14 and Chapter 15, Momentum 2 and 3, Individual Indicators. A deep dive into specific momentum indicators, including how they're constructed, interpreted, and used in real-world trading. Chapter 16, Candlestick Charting. Exploring one of the most powerful visual charting methods, packed with patterns that reveal market psychology at a glance. Chapter 17, Point and Figure Charting. A simplified, noise-reduced charting technique that focuses purely on price movement, no timescale required. Chapter 18, Miscellaneous Techniques for Determining Trends. Additional tools and methods traders use to identify trend direction and potential turning points. Chapter 19, The Concept of Relative Strength. Understanding how to compare assets, sectors, or markets to identify leadership and weakness. Chapter 20, Putting the Indicators Together. The DJ Transport's 1990-2001. A full practical case study showing how all these tools work in combination over an extended market period. Stay tuned as we break down each chapter into clear, listening-friendly segments designed to help you understand and apply these techniques in your trading journey.
Chapter 13. Momentum 1, Basic Principles. The methods of trend determination considered so far have been concerned with analysis of the movement of the price itself through trend lines, price patterns, and moving average MA analysis. These techniques are extremely useful, but they identify a change in trend only after it has taken place. The use of momentum indicators can warn of latent strengths or weaknesses in the indicator or price being monitored, often well ahead of the final turning point. This chapter will examine the general principles of momentum interpretation that apply in some degree or another to all such oscillator-type indicators. Rate of change will be used as a case study. Subsequent 2 chapters will discuss other specific momentum indicators. Introduction. The concept of upside momentum is illustrated in the following example. When a ball is thrown into the air, it begins its trajectory at a very fast pace, i.e., it possesses strong momentum. The speed at which the ball rises gradually diminishes until it finally comes to a temporary standstill. The force of gravity then causes it to reverse course. This slowing down process, known as a loss of upward momentum, is a phenomenon that is also experienced in financial markets. The flight of a ball can be equated to a market price. The price's rate of advance begins to slow down noticeably before the ultimate peak in prices is reached. On the other hand, if a ball is thrown inside a room and hits the ceiling while its momentum is still rising, the ball and the momentum will reverse at the same time. Unfortunately, momentum indicators in the marketplace are not dissimilar. This is because there are occasions on which momentum and price peak simultaneously, either because a ceiling of selling resistance is met or because buying power is temporarily exhausted. Under such conditions, the level of momentum is often as helpful as its direction in assessing the quality of a price trend. Major technical principle: the use of momentum indicators can warn of latent strengths or weaknesses in the indicator or price being monitored, often well ahead of the final turning point. The idea of downward momentum may be better understood by comparing it to a car that is pushed over the top of a hill. The car begins to roll downhill, and as the gradient of the hill steepens to accelerate, at the bottom, it reaches maximum velocity. Although its speed then begins to decrease, the car continues to travel, but finally it comes to a halt. Market prices act in a similar fashion. The rate of decline or loss of momentum often slows ahead of the final low. This is not always the case, however, since momentum and price sometimes, as it peaks, turn together as prices meet a major level of support resistance. Nevertheless, momentum leads price often enough to warn of a potential trend reversal in the indicator or market average that is being monitored. Momentum is a generic term, just as fruit describes apples, oranges, grapes, etc. So momentum embraces many different indicators. Examples include rate of change (ROC), the relative strength indicator (RSI), moving average convergence divergence (MACD), breadth oscillators, and diffusion indexes. There are essentially 2 broad ways of looking at momentum. The first uses price data for an individual series, such as a currency, commodity, stock, or market average, and manipulates it in a statistical form that is plotted as an oscillator. We'll call this price momentum, although volume can be manipulated in the same way. The second is also plotted as an oscillator, but is based on statistical manipulation of a number of market components, such as the percentage of New York Stock Exchange, NYSE stocks above a 30-week MA. This measure is referred to as breadth momentum and is discussed in Chapter 27. Price momentum can be constructed for any price series, but breadth momentum can be calculated only for a series that can be broken down into various components. Major technical principle. The principles or characteristics of momentum interpretation are the same for all indicators, but some are specially constructed to bring out a particular characteristic. This chapter outlines the 8 basic principles. For further study, please refer to the Definitive Guide to Market Momentum, Martin J. Pring, 2009, Traders Press, or the Momentum module at the online Technical Analysis course at Pringcom. We will be using ROC as an example, but you should remember that it is only one type of price momentum indicator. Chapters 14, 15, 26, and 27 will discuss other individual indicators for price and breadth momentum, respectively. It should be noted that the type of trend reversal signaled by a momentum indicator depends upon the time span over which it has been calculated. It is accepted practice to use daily data for identifying short-term trends, weekly data for intermediate trends, and monthly data for primary trends. It is very important to note that the use of momentum indicators assumes that markets or stocks are experiencing a normal cyclic rhythm, which is expressed in price action by rallies and reactions. However, in some instances, countercyclical reactions are almost non-existent. Price movement is then reflected as a linear uptrend or downtrend. This is an unusual phenomenon, and when it develops, momentum indicators fail to work. Major technical principle. It is of paramount importance to use momentum analysis in conjunction with some kind of trend reversal signal in the price series itself. Momentum interpretation. Rate of change. The simplest way of measuring momentum is to calculate the rate at which a security price changes over a given period of time. This is known as a rate of change ROC indicator. If it is desired, for example, to construct an ROC using a 10-week time span, the current price is divided by the price 10 weeks ago. If the latest price is 100, and that one 10 weeks ago was 105, the ROC or momentum indicator will read 95.2, that is, 100 divided by 105. The subsequent reading in the indicator will be calculated by dividing next week's price by the price 9 weeks ago. See Table 13.1. The result is a series that oscillates around a central reference point. This horizontal equilibrium line represents the level at which the price is unchanged from its reading 10 weeks ago, Figure 13.1. If an ROC calculation were made for a price that remained unchanged, its momentum index would be represented by a straight line. When an ROC indicator is above the reference line, the market price that it is measuring is higher than its level 10 weeks ago. If the ROC indicator is also rising, the difference between the current reading of the price and its level 10 weeks ago is growing. If an ROC indicator is above the central line but is declining, the price is still above its level 10 weeks ago, but the difference between the two readings is shrinking. When the ROC indicator is below its central line and falling, the price is below its level 10 weeks ago, and the difference between the two is growing. If the indicator is below its central line but rising, the price is still lower than its level 10 weeks ago, but its rate of decline is slowing. In short, a rising ROC indicator implies expanding velocity, and a falling one implies a loss of momentum. Rising momentum should be interpreted as a bullish factor, and declining momentum as a bearish one. There are two methods of scaling an ROC chart. Since the choice does not affect the trend or level of the index, the method used is not important, but a brief explanation is in order because the two alternatives can be confusing. The first method is the one described earlier and shown in Figure 13.1, where 100 becomes the central reference point. In the example, 100, this week's observation divided by 99, the observation 10 weeks ago is plotted as 101, 100 divided by 98 as 102, 100 divided by 102 as 98, and so on. The alternative is to take the difference between the indicator and the 100 level and plot the result as a positive or negative number, using a reference line of 0. In this case, 101 is plotted as +1, 102 as +2, 98 as 2, and so on. See Figure 13.2. Selection of time span. Choosing the correct time span is important. For longer-term trends, a 12-month or 52-week momentum is generally the most reliable, although a 24 or 18-month period can also prove useful. For intermediate trends, a 9-month, 26-week 6-month, or 13-week 3-month momentum works well. Price movements of even shorter duration are often reflected by a 10, 20, 25, or 30-day span. Reliable short intermediate movements are often reflected with a 45-day 9-week span. Major technical principle. The analysis of any technical situation will be enhanced by the calculation of several momentum indicators, each based on a different time span. In this way, trend lines, price patterns, or divergences, which may not be apparent in one period, are more apparent in another. The discovery of signs of a trend reversal in several indicators constructed from different time spans adds further fuel to the weight of the evidence. An example of this is featured in Chart 13.1 for the iShares MSCI World Stock ETF, symbol AQUI, just prior to the 2007 to 2009 bear market. Note that the trend line for the price was violated more or less simultaneously, with the 12-month M for a stronger signal than just the trend line on its own. Principles and applications of momentum indicators. The following description of the principles and use of momentum indicators applies to all forms of oscillators, whether constructed from an individual price series or from an index that measures internal market momentum, such as those described in Chapter 27. These principles can be roughly divided into two broad categories. 1. Those that deal with overbought conditions, oversold conditions, divergences, and the like. I will call these momentum characteristics. If you study momentum indicators or oscillators, you'll find that they have certain characteristics that are associated with subsurface strengths or weaknesses in the underlying price trend. It's rather like looking under the hood of an engine. Quite a lot of the time you can identify mechanical trouble before it becomes self-evident. Momentum and sentiment are closely allied, and the relationship between them is discussed in Chapter 29. 2. The identification of trend reversals in the momentum indicator itself. I will call these momentum trend reversal techniques. In this case, we are making the assumption that when a trend in momentum is reversed, prices will sooner or later follow. Trend-determining techniques, such as trendline violations, moving average crossovers, etc., when applied to momentum, are just as valid as when utilized with price. The difference, and it is an important one, is that trend reversal in momentum is just that, a reversal in momentum. Momentum typically reverses along with price, often with a small lead, but just because oscillators change direction doesn't always mean that prices will too. Normally, a reversal in the momentum trend acts as confirming evidence of a price trend reversal signal. In effect, this momentum signal performs the act of supplementary witness in our weight of the evidence approach. I will have more to say on this one a little later, but for now, take special note of the fact that actual buy and sell signals can only come from a reversal in trend of the actual price, not the momentum series. Momentum characteristics. 1. Overbought and oversold levels. Perhaps the most widely used method of momentum interpretation is the evaluation of overbought and oversold levels. This concept can be compared to a person taking an unruly dog for a walk on a leash. The leash is continually being pulled from one side of the person to the other as the dog struggles to get free. Despite all its activity, however, the dog can move no farther away than the length of the leash. The same principle holds true for momentum indicators in the marketplace, except that the market's leash should be thought of as made of rubber, so that it is possible for particularly strong or weak price trends to extend beyond the normal limits, known as overbought and oversold levels. These areas are drawn on a chart at some distance above and below the equilibrium level, as in Figure 13.3. The actual boundaries will depend on the volatility of the price being monitored, and the time period over which the momentum indicator has been constructed. For example, an ROC indicator has a tendency to move to wider extremes over a longer period than over a shorter one. It is highly unlikely that a price will move 10% over a 10-day period. Yet, Over the course of a primary bull market extending over a 12-month period, a 25% increase would not be uncommon. Some indicators, such as the RSI and stochastic, have been specially constructed to move within definite predetermined boundaries. When a price reaches an overbought or oversold extreme, the probabilities favor, but by no means guarantee, a reversal. An overbought reading is a time to be thinking about selling, and an oversold one warns that the current technical position may warrant a purchase. In many cases, when a price reaches an overbought extreme, the news is good, participants are optimistic, and human nature tells us to buy. Unfortunately, the opposite is more likely to be the case. On the other hand, an oversold reading is usually associated with a negative news background. The last thing we want to do is raise our shaking hand, pick up the phone, and call our friendly broker or nervously click online, but that is often a reasonable time to do it, provided the overall technical position is favorable. In view of the variability of indicators such as ROC, there is no hard and fast rule about where the overbought and oversold lines should be drawn. This can be determined only by studying the history and characteristics of the security being monitored. They should be drawn such that they will act as pivotal points, which, when touched or slightly exceeded, are followed by a reversal in the oscillator. When a particularly sharp price movement takes place, these boundaries will become totally ineffective. Unfortunately, this is a fact of life, but by and large, it is usually possible to construct overbought and oversold benchmarks that are price-sensitive. Again, the market leash is made of rubber and can remain in overbought or oversold territory for long periods. Consequently, it is essential to get confirmation from a reversal in the trend of the price itself before taking any drastic action. 2. Oscillator characteristics in primary bull and bear markets. I mentioned earlier that the character of an oscillator alters according to the price environment. In a bull market, oscillators tend to move into an overbought condition very quickly and stay there for a long time. In a bear market, they can and do remain in an oversold condition for a long time. In effect, an oscillator is not unlike a migrating bird in the northern hemisphere. I've divided the price action in figure 13.4 into a bear market, followed by a bull, and finally another bear market. As we enter the bear phase, the true range of the oscillator shifts to the south, in a similar way to a bird in the northern hemisphere migrates south to escape the cold northerly winter. Then, when the bull market starts, the oscillator's trading pattern migrates north again. As a new bear market begins, just like the bird, the oscillator finally shifts south again. This is useful information in itself, for if it's possible to draw parallel horizontal lines like these against an oscillator, it provides a valuable clue as to whether the prevailing primary trend is bullish or bearish. Major technical principle: oscillators behave in different ways, depending on the direction of the primary trend. The second point is that if you have an idea of the direction of the primary trend, you can anticipate what price action might follow from a specific overbought or oversold reading. In a bull market, the price is extremely sensitive to an oversold condition. That means that when you are lucky enough to see one, look around for some confirming signals that the price is about to rally. An example might be the violation of a downtrend line, etc. The reason for this sensitivity lies in the fact that the oversold reading very likely reflects an extreme in short-term sentiment. Market participants are focusing on the latest bad news and using that as an excuse to sell. Since this is a bull market, they would be better served by remembering the positive long-term fundamentals that will soon emerge and using this weakness as an opportunity to buy. The same thing happens in reverse during a bear market. Traders are focused on bad news, which sends the price down. Then, some unexpectedly good news hits the wires and the price rallies. However, when it is fully digested, most people realize that things really haven't changed at all and the price declines again. Thus, the overbought reading more often than not will correspond with the top of a bear market rally. Looking at it from another perspective, during a bull market, the price will be far less sensitive to an overbought condition. Often, it will be followed by a small decline or even a trading range as at point A in figure 13.4. The rule, then, is don't count on a short-term overbought condition to trigger a big decline because the odds do not favor it. Finally, people often point to an oversold condition and use that as their rationale for a rally. Your favorite financial columnist might say, analysts point out that the market is deeply oversold and a snapback rally is expected. Once again, It very much depends on the environment. In a bull market, that's true, but the columnist is more likely to say that, despite a short-term oversold condition, analysts are expecting lower prices because. Then the columnist will go on to list a load of bearish factors justifying his or her position. Remember, the media tend to reflect the crowd, which is usually wrong at turning points and do not make accurate forecasts, especially when quoting experts. In a bear market, though, a market or stock is far less sensitive to an oversold reading, often failing to signal a rally, or possibly being followed by a trading range, as at point B in figure 13.4. The maturity of the trend, whether primary or intermediate, often has an effect on the limits that an oscillator might reach. For example, when a bull market has just begun, there is a far greater tendency for it to move quickly into overbought territory and to remain at very high readings for a considerable period of time. In such cases, the overbought readings tend to give premature warnings of declines. During the early phases of the bull cycle, when the market possesses strong momentum, reactions to the oversold level are much more responsive to price reversals, and such readings, therefore, offer more reliable signals. It is only when a bull trend is maturing, or during bear phases, that overbought levels can be relied upon to signal that a rally is shortly to be aborted. The very fact that an indicator is unable to remain at, or even to achieve, an overbought reading for long is itself a signal that the advance is losing momentum. The opposite is true for a bear trend. 3. Overbought, oversold recrossovers. In most cases, excellent buy and sell alerts are generated when the momentum indicator exceeds its extended overbought or oversold boundary and then recrosses back through the boundary on its way to zero. Figure 13.5 demonstrates this possibility. This approach filters out a lot of premature buy and sell signals generated as the indicator just reaches its overextended boundary, but one should still wait for a trend reversal in the price itself before taking action. 4. Mega overboughts and oversolds. As discussed in Chapter 29, there is a close connection between market sentiment indicators and the characteristics of oscillators. Since market sentiment differs widely during a bull and bear market, it follows that such variations are occasionally reflected in changing characteristics of momentum indicators. I have termed one of these phenomena mega overboughts and oversolds. A mega overbought is the initial thrust in a bull market following the final low. It's a reading in the momentum indicator that takes it well beyond the normal overbought condition witnessed in either a preceding bull or bear market. It should, for example, represent a multi-year high for the oscillator concerned, perhaps even a record overbought reading. Such conditions are usually a sign of a very young and vibrant bull market. The very fact that an oscillator is able to even rise to such a level can be used, along with other trend reversal evidence, to signal that a new bull market has begun. It represents a sign that the balance between buyers and sellers has unequivocally shifted in favor of buyers. It's something like a person using all his strength to crash through a locked door. It takes a tremendous amount of energy to achieve, but once the door is finally shoved open, there is nothing to hold that person back any longer. In the same way, a mega overbought removes the price from its bear market constraints, leaving it free to experience a new bull market. An example is shown in figure 13.6. This is about the only instance when opening a long position from an overbought condition can be justified. Even so, it can only be rationalized by someone with a longer-term time horizon. This is due to the fact that whenever an oscillator experiences a mega overbought, higher prices almost always follow after a short-term setback or consolidation has taken place. A highly leveraged trader may not be able to withstand the financial pressure from the contra-trend move, whereas the long-term investor can. In most instances, you will probably find that the correction following the mega overbought is a sideways rather than a downward one, but there are just enough exceptions to cause the over-leveraged trader a lot of sleepless nights. Since a mega overbought is associated with the first rally in a bull market, it's a good idea to check and see if volume is also expanding rapidly. If it takes the form of record volume for that particular security, the signal is far louder because record volume coming after a major decline is typically a reliable signal of a new bull market. Expanding volume is a more or less necessary condition, since it is consistent with the idea that buyers now have the upper hand, and that the psychology has totally reversed. Having said that, there are occasions when a mega overbought is followed not by a reversal, but by a change in trend. In other words, the previous bear market emerges into a multi-year trading range rather than a full-fledged bull market. The point here is that the low that precedes the mega overbought is not normally decisively violated for many years. The same concept also appears in reverse for oversold extremes. Consequently, when a price decline following a bull market high pushes a momentum indicator to a new extreme low, well beyond anything witnessed either during the previous bull market or for many years prior to that, the implication is that sellers now have the upper hand. The fact that it is possible for the momentum indicator to fall so sharply and so deeply is in itself a sign that the character of the market has changed. When you see this type of action, you should, at the very least, question the bull market scenario. Look for telltale signs that a new bear market may be underway. What are the volume configurations on the subsequent rally? Does volume now trend lower as the price rises compared to previous rallies that were associated with trends of rising volume? And so forth. The same possibilities of a change, as opposed to a reversal in trend, also apply in the sense that a mega oversold is typically the first decline in a bear market, but occasionally it can also signal a change in trend from a primary bull market to a multi-year trading range. An example of a mega oversold is shown in Figure 13.7. Both mega conditions are usually best observed in short-term oscillators, with a time span ranging from 10 to as many as 30 days. On weekly charts, it's also possible to go out as much as 13 weeks, though obviously such signals are less timely than those derived from shorter-term time spans. They never develop from indicators whose construction constrains their fluctuations between 0 and 100, such as the RSI and stochastic. Chart 13.2 features the SPDR Technology ETF symbol XLK at the 2009 primary bear market low. See how the high reading in the 10-day ROC exceeds anything seen prior for a classic mega overbought signal. This is quite remarkable when you remember that the first sign of a primary trend reversal is given within 10 days of the bear market low. This is not sufficient evidence to call a turn, but certainly enough to alert the observant analyst to be looking around for confirming evidence, such as a break above the horizontal trend line flagging the completion of a double bottom. 5. Extreme swings. The extreme swing is another phenomenon that signals a dramatic shift in psychology. It reflects the idea that some primary trend reversals are signaled by a swing from unbelievable exuberance as the bull market reaches its peak, to one of complete despondency and depression as the first bear market setback gets underway. The opposite is true of a transition from a primary bear to a primary bull market. In order for an extreme swing to develop, it is necessary to experience a prolonged uptrend or downtrend. The extreme swing then appears in a momentum indicator by an especially strong move in the direction of the then prevailing trend, as shown in Figure 13.8. This is then followed by an extreme reading in the opposite direction. In Figure 13.8, we see a blow-off to the bull move as the oscillator reaches a highly overbought reading. This is subsequently followed by a price decline that pushes it to the other extreme. Such action indicates a dramatic shift in sentiment as market participants change from a mood of euphoria to one of despondency as the market eventually reacts in the opposite direction to that originally expected. In order to qualify for an extreme swing, the first swing must represent the strongest move in several years, certainly the strongest since the initial thrust from the previous bear market bottom. It is really a climax move for the bull market. The second swing to the downside should really be a mega oversold, though in some cases, an extreme oversold will suffice. This phenomenon undoubtedly occurs because the first swing encourages participants who have been right about the prevailing trend and discourages those who have been wrong. In the case of a bull market, the final rally also squeezes out all of the remaining shorts, so when the trend reverses, there is virtually no buying activity from speculators covering short positions. The preceding sharp advance also encouraged buyers who could see that there was only one way prices could go, and that was up. As a result, decisions on the buy side are made carelessly and without thought for the fact that prices may move the other way. When they do, such individuals are flushed out of the market with no quarter given. Since there are few short sellers able to pick up the pieces, the price drops ferociously. Extreme swings also develop between a bear and bull primary trend, as featured in Figure 13.9. In this case, though, The mood swing is from total despondency and depression, as the bear market squeezes out the last of the bulls, to one of disbelief, as the market reverses to the upside. At market bottoms, it is the shorts who gain confidence from the sharp and persistent downtrend. Even the strongest bulls are forced to capitulate, and eventually there is no one left to sell. Then, during the rally phase, the shorts are forced to cover, and new buying comes in because of the perceived improvement in the fundamentals. Since there is virtually no one left to sell, prices shoot up and a mega or extreme overbought is registered. Needless to say, extreme swings are quite unusual, but when you can spot them, it really pays to follow their lead, since a new trend invariably results. Chart 13.3 shows an example of a bullish extreme swing for the China iShare, symbol FXI, at the 2007 to 2009 primary bear market low. Note that in this case, the bullish part of the pattern was also a mega overbought condition. It barely qualified though, because although it was a multi-year overbought following a bear market, that decline was only a few months longer than our minimum requirement of 9 months for one of these phenomena. Major technical principle, mega and extreme conditions represent preliminary signals of a primary trend reversal. Confirmation by the price usually puts the issue beyond reasonable doubt. 6. Divergences. The ball example used at the beginning of the chapter showed that maximum velocity was obtained fairly close to the point at which the ball leaves the hand. Similarly, prices in financial markets usually reach their maximum level of momentum ahead of the final peak in prices. In figure 13.10, this is shown at point A. If the price makes a new high, which is confirmed by the momentum index, no indication of technical weakness arises. On the other hand, if momentum fails to confirm point B, a negative divergence is set up between the two series, and a warning of a weakening technical structure is given. Such discrepancies normally indicate that the price will undergo a corrective process. It can take the form of either a sideways or a horizontal trading range, or, more likely, a downward one. However, the price will sometimes continue upward to a third top and be accompanied by even greater weakness in the momentum index, point C. Occasionally, the third peak in the momentum index may be higher than the second but lower than the first. Either circumstance requires some degree of caution, since this characteristic is a distinct warning of a sharp reversal in price or a long corrective period. Figure 13.10 also shows a positive divergence. In this instance, the price makes its low at point E, but this was preceded by the oscillator, which bottomed at D. Major technical principle. It is extremely important to note that divergences only warn of a weakening or strengthening market condition, and do not represent actual buy and sell signals. Whenever any divergence between momentum and price occurs, it is essential to wait for a confirmation from the price itself that its trend has also been reversed. This confirmation can be achieved by 1. The violation of a simple trend line, as shown in figures 13.10 and 11. 2. The crossover of a moving average MA. Or 3. The completion of a price pattern. This form of insurance is well worth taking, since it is not unknown for an index to continually lose and regain momentum without suffering a break in trend during a long cyclical advance. Examples of this phenomenon occurred during the 1962 to 1966 bull market in U.S. stocks, and in Japanese stocks between 1982 and 1990. Major technical principle. As a general rule, the greater the number of negative divergences, the weaker the underlying structure. Good example can be seen in chart 13.4, which shows the Nikkei index violating an important 3.5-year secondary trend line after the 13-week ROC indicator had negatively diverged several times with the index. As a result, the final rally was accompanied by very little in the way of upside momentum. It would have been a mistake to sell on any of the prior divergences, but a very timely sell signal was generated by waiting for a confirmation in the form of a trend break in the index itself through a negative 65-week EMA crossover. Major technical principle. A divergence that develops close to the equilibrium line is often followed by a sharp price move when confirmed by the price. Point C in figure 13.11, the price moves to a significant new high, but the momentum indicator is barely able to remain above the equilibrium line. Such a situation demands the utmost caution when accompanied by a trend break, for it is usually a sign of extreme technical weakness and is often, though certainly not always, followed by a very sharp decline. The opposite type of situation, figure 13.12, in a bear market should be viewed as a very positive characteristic, especially if the upward trend break in price is accompanied by high volume. The more explosive the volume, the more reliable the signal is likely to be. In a sense, it is possible to equate momentum divergences and price trend breaks with dark clouds and rain. If you look up at the sky and observe dark clouds, common sense tells you that it will probably rain, but you do not know for sure until you can hold out your hand and actually feel rain falling. In other words, the clouds, like the divergences, warn of the deteriorating weather technical condition, but the change is signaled only by the first raindrop reversal in the price. It is possible to take the analogy a step further by concluding that the darker the clouds, the greater the number of divergences. The heavier the rainstorm, the sharper the price decline will be. 7. Price discrepancy divergence. A further indication of subtle strength or weakness is given when the momentum series moves strongly in one direction, but the accompanying move in the price index is a much smaller one. Such a development suggests that the price index is tired of moving in the direction of the prevailing trend, for despite a strong push of energy from the momentum index, prices are unable to respond. This unusual but powerful phenomenon is illustrated for both tops and bottoms in figures 13.13 and 13.14. The mid-1990 rally in the 13-week ROC for the Nikkei and chart 13.4 represents good example. Note also how the price was turned back a couple of times by the 65-week EMA. 8. Complex divergences. It is widely recognized that price movements are simultaneously influenced by several cyclic phenomena. Because a single momentum indicator can monitor only one of these cycles, it is always a good idea to compare several different momentum indicators based on differing time spans. One approach is to plot two momentum indicators of differing time spans on the same chart, as shown in figure 13.15. Since this method tries to monitor two separate cycles, it is wise to choose two widely different time spans. For example, not much could be gained from the comparison of a 12 and a 13-week ROC since they would move very closely together. On the other hand, a combination of 13 and 26-week spans would clearly reflect different cycles. Most of the time, the two indicators are moving in gear, so this study does not give us much information. On the other hand, when the longer-term indicator reaches a new peak and the shorter one is at or close to the equilibrium line, they are clearly in disagreement or out of gear. Point A2, figure 13.15. This normally, but not necessarily, indicates that a reversal in trend will take place, and it is usually an important one. Even so, it is very important to make sure that any such divergence is confirmed by a reversal in the price trend itself. In figure 13.15, a trend break does occur, but in figure 13.16, no reversal took place and the price continued on upward. Complex divergences also occur in a positive combination, as indicated later on at point B1 in figure 13.15. But again, it is mandatory to wait for that trend reversal signal in the price itself. An example in chart 13.5 features the United States oil ETF. Note that it offers a good example of a positive and negative complex divergence, together with a confirmation. Generally speaking, the wider the divergent time spans within reason, the more likely you will be to spot these interesting characteristics. Momentum trend reversal techniques. 1. Trendline violations. Occasionally, it is possible to construct a trend line on the momentum indicator by connecting a series of peaks or troughs. An example for an uptrend reversal is shown in figure 13.17. When the line is violated, a trend reversal signal for the oscillator is generated. The construction and significance of the break should be based on the principles outlined in Chapter 6. This type of momentum weakness must be regarded as an alert, and action should be taken only when confirmed by a break in the price trend itself, indicated at point A in figure 13.17. In effect, the momentum trend break is reinforcing the price trend break, and it offers an additional piece of evidence that the trend has reversed. An example signaling a new uptrend is featured in figure 13.18. It is possible for the momentum trend break to precede that of the price by some time, yet it does not generally lose its potency because of this. Major technical principle. As a general rule, it does appear that if both lines are violated more or less simultaneously, or if the price trend is violated first, strength of the signal is enhanced. It should also be noted that momentum trendline breaks can be confirmed by any legitimate trend reversal technique in the price, be it a moving average crossover, price pattern, peak-trough progression reversal, etc. 2. Momentum price patterns. Momentum indicators are also capable of tracing out price patterns. Because of the shorter lead times normally associated with reversals of falling momentum, a breakout from an accumulation pattern, when accompanied by a reversal in the downward trend of the price itself, is usually a highly reliable indication that a worthwhile move has just begun. An example is shown in Figure 13.19. It is important to use a little common sense in interpreting momentum price patterns. Figure 13.20, for example, shows a breakout from a reverse head and shoulders H and S pattern that takes place from an overbought condition. This is not to say that such signals will never be valid, but it stands to reason that a breakout from an extreme level is very unlikely to result in a sustainable price move. Remember, technical analysis deals with probabilities, and the odds of a favorable outcome in this case are low. If you want a tip-off, this type of failure typically develops in a contra-trend way as a false upward breakout in a primary bear market or false downside move in a primary bull market. Chart 13.6 is rich in examples of momentum trendline breaks and price pattern completions. The September 2012 break of the dashed-up trendline is a classic example of why it is important to wait for some price confirmation, as the failure of the price to do this was followed by a really good rally. 3. Equilibrium crossovers. Some technicians have devised indicators that offer buy and sell signals when the momentum indicator crosses above and below its equilibrium or zero line. Many markets do not lend themselves to this approach, so its implementation depends very much on a trial and error basis through experimentation. In any event, it is always a good idea to use this method in conjunction with a reversal in the price itself. Chart 13.7 shows how zero crossovers used in conjunction with 12-month ROC crossovers have consistently given reliable buy signals for the Economist All Items Commodity Index. The two sets of ellipses point up a couple of whipsaw signals. 4. Momentum and moving averages. By now, it is apparent that all the trend-determining techniques used for price are also applicable to momentum. Interpretation of momentum indicators, as described earlier, depends to a considerable extent on judgment. One method of reducing the subjectivity is to smooth the ROC index by using an MA. Warnings of a probable trend reversal in the price being monitored are offered by momentum moving average crossovers, as indicated in Figure 13.21. One of the problems associated with this approach is that the momentum indicator is often much more jagged than the price index that it is trying to measure, causing the generation of an unacceptable number of whipsaw signals. It is possible to filter out some of these whipsaws by using a combination of 2M as shown in Figure 13.22. Buy and sell alerts are given when the shorter-term EMA crosses above or below its longer-term counterpart. This interpretation of momentum is explained in greater detail in the next chapter, since momentum forms the basis of the trend deviation and MACD indicators. Smoothed momentum indicators. Another way of incorporating M as into momentum studies is to smooth the momentum indicator by a long-term MA. The meaning of long-term in this case will depend on the type of trend being monitored. For example, a 20 to 30-day time span would be suitable for a short-term price movement, but a 6, 9, 12-month or even longer smoothing is more appropriate for a primary trend. Warnings of a probable trend reversal in the price would be offered by a reversal in the smoothed momentum index itself, as shown in Figure 13.23. Example A, or by a penetration of the M through a designated overbought or oversold level, as in Example B. The level of the dashed overbought and oversold barrier would be determined on a trial and error basis, with reference to a historical study of the relationship between the price and the momentum curve. If the momentum series is found to be unduly volatile, it is always possible to smooth out fluctuations by calculating an even longer-term MA, or by smoothing the EMA itself with an additional calculation. Another possibility is to construct an oscillator by combining the M as of 3 or 4 ROCs and weighting them according to their time span. This possibility is discussed at length in Chapter 15. Chart 13.8 shows the effectiveness of combining two ROC indicators and smoothing them. In this case, The smoothing is a 10-month weighted average of 11 and 14-month rates of change of the S&P Composite monthly closing prices. This was an approach devised by ESC Kapuk. Since this indicator has been found useful for market bottoms rather than tops, the momentum curve is significant only when it falls below the zero reference line and then rises. The arrows show that bull market signals between 1982 and 2012 were particularly timely. I've traced this indicator back to 1900 and found that only 3 signals out of 29 in 1913, 1941, and 2002 were premature. Clearly an excellent track record. Even these signals could have been filtered by requiring a positive 12-month EMA crossover. Please note that this indicator can be just as easily applied to other markets or relationships. The lower panel shows how it is possible to also incorporate trendline violations and price pattern completions using the raw data, i.e., the sum of the two ROCs. A further variation on construction of a smoothed momentum index is to take the ROC of an EMA of a price index itself. This method reverses the process described earlier, for instead of constructing an ROC and then smoothing the resulting momentum index, the price index itself is first smoothed with an EMA and an ROC is taken of that smoothing. Summary. 1. Momentum is a generic term embracing many different types of oscillators. 2. Momentum measures the rate at which prices rise or fall. It gives useful indications of latent strengths or weakness in a price trend. This is because prices usually rise at their fastest pace well ahead of their peak and normally decline at their greatest speed before their ultimate low. 3. Since markets generally spend more time in a rising than a falling phase, the lead characteristic of momentum indicators is normally greater during rallies than during reactions. 4. Oscillators reflect market sentiment and have different characters in primary bull and bear markets. 5. There are 2 basic methods of interpreting momentum characteristics and momentum trend reversals. 6. Momentum signals should always be used in conjunction with a trend reversal signal by the actual price. Chapter 14. Momentum 2. Individual indicators. It is recommended that you study all of the momentum indicators described in this and the next chapter, subsequently selecting the 2 or 3 with which you feel intuitively comfortable with. Following too many indicators will likely lead to confusion. If you wish to find a more in-depth explanation of these and many other momentum indicators, please refer to my definitive guide to momentum indicators, Marketplace Books, 2009, or the momentum module in my online audiovisual course at pring.com. The RSI, the formula. The relative strength indicator RSI was developed by Wells Wilderell. It is a momentum indicator or oscillator that measures the relative internal strength of a stock or market against itself, instead of comparing one asset with another or a stock with a market. The formula for the RSI is as follows. RSI equals 100 minus 100 over 1 plus RS, where RS equals the average of X days up closes divided by the average of X days down closes. The indicator's design aims to overcome 2 problems involved in construction of a momentum indicator. 1. Erratic movements, and 2. The need for a constant trading band for comparison purposes. Erratic movements are caused by sharp alterations in the values, which are dropped off in the calculation. For example, in a 20-day rate of change ROC indicator, a sharp decline or advance 20 days in the past can cause sudden shifts in the momentum line even if the current price is little changed. The RSI attempts to smooth out such distortions. The RSI formula not only provides this smoothing characteristic, but also results in an indicator that fluctuates in a constant range between 0 and L00. The default time span recommended by Wilder is 14 days, which he justified on the basis that it was half of the 28-day lunar cycle. Unfortunately, the lunar cycle includes weekends and therefore has more than 14 trading days. Nonetheless, this default time span works quite well in reality, and that's what really counts. The RSI is useful for making comparisons between securities. The nature of the RSI calculation allows the accurate comparison of different securities on the same chart. In Chart 14.1, there are 2 series, the Dow Jones Utilities and the Philadelphia Gold and Silver Share Index. The upper panel plots a 45-day ROC and the lower one a 45-day RSI. With the ROC, it is not possible to easily compare the two because the utilities are far less volatile. On the other hand, you can see that the divergence in volatility is far less in the lower panel featuring the RSI. Constructing overbought-oversold lines. Because of this, it is much easier to establish universal standards for the overbought and oversold benchmarks. Using the 14-day default, they are traditionally set at 30 for oversold and 70 for overbought. In an article entitled How RSI Behaves, Peter W. Ahn argued that the average value of an RSI top and bottom occurred close to the 72 and 32 levels, respectively. This research would indicate that the 70 and 30 levels recommended by Wilder should be moved further apart to better reflect the average overbought and oversold value. It is important to note that the magnitude of the oscillations of the RSI is inverse to that of most other momentum series. For example, the ROC indicator is subject to wider fluctuations as the time span becomes longer. It works in an opposite way for the RSI. For the RSI, equilibrium is the halfway point, which in this case is the 50 level. It is, therefore, traditional to place the overbought-oversold lines equidistant from this point. We should remember that longer time spans in the RSI calculation result in shallower swings and vice versa. Consequently, the 70/30 combination is inappropriate when the time span differs appreciably in either direction from the standard 14-day period. Chart 14.2, for example, features a 9-day RSI for the Hang Seng Index in Hong Kong, where an 80/20 combination gives a much better feel for the overbought-oversold extreme than the 70/30 default value. This is due to the fact that shorter time spans result in wider RSI oscillations. The lower panel features a 65-day RSI, where the narrower swings result in a more appropriate 62.5/37.5 combination. In this instance, neither of the default 70/30 values is reached at any time. The terms long and short with regard to time spans refer to the type of data under consideration in a relative sense. For example, a 60-day RSI would represent a long span for daily data, but for monthly numbers, a 60-day, i.e., 2-month, span would be very short. Some consideration should therefore be given to this factor when choosing a specific RSI time span. Chart 14.3 plots two RSIs for identical time periods, 60 days or 2 months. However, the overbought-oversold lines are drawn at different levels because one calculation is based on daily and the other on monthly data. Because RSIs based on shorter-term time spans are more volatile, they are more suitable for pointing out overbought and oversold conditions. On the other hand, longer-term spans are more stable in their trajectories and therefore lend themselves better for the purpose of constructing trend lines and price patterns. Time spans. The RSI can be plotted for any time span. In his book, The New Commodity Trading Systems and Methods, Wiley, 1987, Perry Kaufman questions the exclusivity of the 14-day time span, the default selection. He points out that maximum divergence occurs when the moving average is exactly half the time span of the dominant cycle. In other words, if you make the assumption that the primary trend of the stock market revolves around the 4-year business cycle, a moving average of 24 months will give you the greatest divergence between the high and low points of the cycle. In the case of the 28-day cycle, 14 days is the correct choice, but it is important to understand that there are many other cycles. Working on this assumption, for example, would mean that a 14-hour RSI would be inappropriate if the dominant cycle was something other than 28 hours. The same would be true for weekly and monthly data. In practice, a 14-day time span works quite well, but only for shorter periods. I also use 9, 25, 30, and 45-day spans. For weekly data, the calendar quarters operate effectively, so 13, 26, 39, and 52-week spans are adopted. As for monthly charts, the same spans for the ROC are recommended, i.e., 9, 12, 18, and 24 months. For longer-term charts covering perhaps 2 years of weekly data, a time span of about 8 weeks offers enough information to identify intermediate-term turning points. A 26-week RSI results in a momentum series that oscillates in a narrower range, but nevertheless, usually lends itself to trendline construction. Very long-term charts, going back 10 to 20 years, seem to respond well to a 12-month time span. Crossovers of the 30% oversold and 70% overbought barriers give a very good idea of major long-term buying and selling points. When the RSI pushes through these extremes and then crosses back toward the 50 level, it often warns of a reversal in the primary trend. Remember, these suggested spans tend to work consistently well, but never perfectly well. If you are looking for perfection, technical analysis is probably not your best analytical choice. To isolate major buy candidates, it is important to remember that the best opportunities lie where long-term momentum, such as a 12-month RSI, is oversold. In this respect, Chart 14.4 shows that an oversold reversal for the S&P using a 12-month RSI has triggered some very prescient signals in the last 100 years. As with all indicators, this one is not perfect, as you can see from the premature buy signal in the early part of the 20th century. More care is needed in identifying tops, as equities have a natural tendency to take longer to build than to tear down. Consequently, overbought reversals have a habit of being premature, especially when the secular trend is a positive one. Returning to buying opportunities, if you can also identify an intermediate and a short-term oversold condition, all three trends, primary, intermediate term, and short term, are then in a classic position to give a high probability buy signal. RSI interpretation. Some of the principal methods used to interpret the RSI are as follows. Extreme readings and failure swings. Anytime an RSI moves above its overbought or below its oversold zone, it indicates the security in question is ripe for a turn. The significance depends upon the time. For example, the 45-hour RSI shown in Chart 14.7 is nowhere near as significant as an RSI constructed with a 12-month time span, as in Chart 14.4. An overbought or oversold reading merely indicates that, in terms of probabilities, a counter-reaction is overdone or overdue. It presents an opportunity to consider liquidation or acquisition, but not an actual buy or sell signal. More often than not, the RSI traces out a divergence, as in Figure 14.1. In this case, the second crossover of the extreme level at points A and B usually offers good buy and sell alerts. These divergences are often called failure swings. We see a bearish failure swing at the end of 2011 at point A, in Chart 14.5 featuring a smoothed version of a 9-day RSI. Trendline violations and pattern completions. The RSI can also be used in conjunction with trendline violations. Generally speaking, the longer the time span for any particular period, i.e., daily, weekly, or monthly, the better the opportunity for trendline construction. Important buy and sell signals are generated when trend lines for both price and the RSI are violated within a relatively short period. Chart 14.6 features a 14-day RSI for Caterpillar. The RSI starts off after a decline by forming a reverse head and shoulders pattern, which is more or less simultaneously confirmed by the price. After a good rally materializes, the RSI violates this uptrend line. Note how the extended line becomes resistance for the final rally. We can also construct a trend line for the price. Finally, the RSI completes a broadening formation with a flat bottom, and a nasty downside break ensues. The next rally peak also experiences a small RSI top, which is confirmed with a trendline violation by the price. An example of the RSI's ability to form price patterns is shown in charts 14.6 and 14.7. Chart 14.7 shows an hourly chart for Intel. It has a 45-hour RSI in the lower panel, which roughly corresponds to a week of trading. I have drawn the overbought-oversold lines at 62 and 38. See what a nice combination of trendline breaks we get in April 2011. We see another setup in late June, where a trendline break on the RSI is confirmed by one on the price. It's even possible to observe a right-angled triangle. If you study the equilibrium line at 50, it's apparent that the strong late June breakout develops slightly above this critical point of balance, smoothing the RSI. It is a perfectly legitimate technique to smooth the RSI. One of my favorite approaches is to smooth a 9-day RSI with an 8-day moving average, MA. Because the fluctuations are not as great as the raw data, the overbought-oversold lines are drawn at 70 and 30, not my usual default of 80-20 for a 9-day span. Chart 14.5, featuring Molex, contains a 9-day RSI smoothed with an 8-day MA. The downward-pointing arrows flag all of the overbought reversals. The solid ones show confirmed reversals with varying degrees of success. The dashed arrows indicate overbought reversals where it was not possible to construct a meaningful trend line. Needless to say, they were all failures. RSI and peak and trough progression. The RSI often traces out a series of rising or falling peaks and troughs, which, when reversed, offer important buy or sell alerts. Chart 14.8 shows that the 14-day RSI for SunTrust banks experienced two peak and trough reversals, each of which was confirmed by a price trend break. These are flagged by the arrows. Two variations on the RSI. Shand Momentum Oscillator. The Shand Momentum Oscillator, CMO, named after its inventor Dr. Tushar Shand, is a variation on the RSI, yet is uniquely different. It has three characteristics. 1. The calculations are based on data that have not been smoothed. This means that extreme short-term movements are not hidden, so the indicator reaches overbought, oversold extremes more often, but not enough to result in too many signals. 2. The scale is confined within the -100 to +100 range. This means that the 0 level becomes the equilibrium point. With the RSI, the 50 level is the equilibrium point and is not always readily identifiable. With 0 as the pivotal point, it is easier to see those periods when momentum is positive and those when it is negative. The 0 equilibrium, therefore, makes comparisons between different securities that much easier as well. 3. The formula uses both up and down days in the calculation. Interpretation. Chart 14.9 compares a 14-day RSI with a 14-day CMO. The first thing to notice is that the CMO reaches an overbought, oversold extreme more times than the RSI, in February and June of 2000 and January of 2001, for instance. Sometimes it is possible to construct timelier and better trend lines for the CMO, though occasionally it works the other way. The March 2000 break, for instance, came off a better trend line for the CMO than the RSI. So, too, did the breaks from trendline A, B, and CD. The two trend lines in the summer of 2000 were slightly better for the RSI. Note also that both series experienced positive divergences at the October 2000 low, but that for the CMO was a much stronger signal, since the September bottom was well above that of mid-October. Doesn't always work in favor of the CMO, but I prefer it because of the more numerous overbought, oversold readings and the plus and minus scaling, which makes it easier to spot positive and negative readings. One approach that I have found helpful is to plot a 20-day CMO and smooth it with a 10-day MA, such as that plotted in chart 14.10. I then take a smoothing of this indicator, in this case, a 10-day simple moving average. That's the dashed line that hugs close to the CMO, using the crossovers to generate buy and sell alerts. However, since there are a lot of moving average crossovers, it's important to try to filter out those that are not likely to work out. That's done by taking crossovers that develop at an extreme level more seriously, since they tend to be more accurate. And make sure that this is confirmed by a trend break in the price. Some examples are shown in the chart. Relative Momentum Index. The Relative Momentum Index, or RMI, is another variation on the RSI. When calculating the RMI, the standard RSI formula is modified to allow for a momentum factor. The actual formula by Roger Altman was published in the February 1993 Stocks and Commodities magazine article. This modification has two effects. First, it smooths the indicator, and second, it accentuates the degree of the fluctuation. The result is a less jagged oscillator that experiences more overbought, oversold readings. The RMI requires two parameters, the time frame and the momentum factor. If the RMI has a momentum factor of 1, the indicator is identical to the RSI. It is only when the momentum factor is greater than 1 that the two series diverge. Chart 14.11 shows two variations on the RMI. The middle panel features a 14-day span with an 8-day momentum factor, and the lower one a 45-day span with a 10-day momentum factor. Since it is an RSI-based indicator, longer-term spans involve less volatility. Note that the fluctuations in the 45-day series are much less pronounced than the 14-day RMI. Generally speaking, the longer-term span offers slower and more deliberate movements that lend themselves more easily to trendline construction. Several examples are shown in chart 14.11. But I particularly like the late 1998 signal since it is confirmed by a simultaneous breakout above the trend line and the 200-day MA. Whenever a price crosses above a trend line and reliable moving average simultaneously, it emphasizes the strength of the signal since they reinforce each other as dynamic resistance areas. RSI conclusion. Most of the time, the RSI and its two variations, like all oscillators, are not telling us very much. It can be really useful when it triggers divergences, complete price patterns, or violate trend lines. When such characteristics are also confirmed by a trend reversal signal in the price itself, it is usually a wise policy to pay attention because the RSI has a good record of reliability. Trend deviation price oscillator. A trend deviation indicator is obtained by dividing or subtracting a security's price by a measure of trend, which is usually a form of MA. It is also possible to base a trend deviation using linear regression techniques. However, we will concentrate on the moving average technique here. This approach is also called a price oscillator in some charting packages. Of the two approaches, subtraction or division is preferred since it is more reflective of proportionate moves. For a discussion on this topic, you are referred to chapters 6 and 8, which compare the logarithmic and arithmetic scales. Chart 14.12 plots the two approaches using a 1/10 price oscillator. The 1 and 10 in the price oscillator legend refer to the fact that a 1-day MA, i.e., the close, is divided by a 10-day MA. Note how the volatility becomes exaggerated as the point movements in the gold price become greater in the last few years. The division calculation returns far more rational swings in the indicator. For short-term charts, where prices do not experience large percentage movements between the low and the high, this is not an important distinction. However, when prices are being compared over many years and there is a substantial net loss or gain over that period, it is wiser to adopt the division approach. Since the average represents the trend being monitored, the momentum indicator shows how fast the price is advancing or declining in relation to that trend. An oscillator based on a trend deviation calculation is, in fact, a horizontal representation of the envelope analysis discussed in Chapter 12. But it also shows subtle changes of underlying technical strengths and weaknesses. The top panel of Chart 14.13 shows the price of Brookline Bancorp and its 50-day MA. Two bands at plus 10 and minus 10% of the 50-day M have been plotted above and below it. The bottom panel represents the same data but expressed in momentum, price oscillator format. Therefore, the M appears as the equilibrium line at 0, and the two bands as overbought and oversold levels at plus 10 and minus 10%. In this way, a negative 0 crossover is the same as a negative 50-day crossover, and so forth. The interpretation of a trend deviation indicator is based on the same principles described in Chapter 13. This method can be used to identify divergences and overbought and oversold zones, but it appears to come into its own when used in conjunction with trendline construction and EMA crossovers. Trendline construction. Chart 14.14 shows the crude oil price together with a trend deviation calculated from a close divided by a 45-day MA. This is a fairly jagged indicator and lends itself to overbought, oversold, trendline, and price pattern analysis. We see a good example of a descending triangle break along with a price confirmation in May 2011. Later on, there is barely any upside momentum at point A, and the price and oscillator both subsequently violate trend lines. Most of the time, it's not possible to forecast the character of a price move following a technical event. In this case, though, the very weak positive momentum at A indicated the vulnerability of the situation. Later on, in June 2012, we see an unconfirmed reverse head and shoulders in the oscillator. I say unconfirmed because it was not really possible to construct a meaningful downtrend line on the price. Finally, a price pattern completion for the oscillator and a trendline violation for the price leave the chart with a confirmed short-term downtrend. Trend deviation and mass. An alternative approach with trend deviation indicators is to smooth out unwanted volatility with the aid of 2M as shown in Chart 14.15. The actual trend deviation series is calculated by taking a 26-week EMA of the closing price divided by a 52-week MA. The second series is simply a 10-week EMA of the first. Buy and sell alerts are then triggered as the smooth trend deviation indicator crosses above or below its 10-week MA. Then look for a confirmation from the price itself. Two examples are shown in chart 14.15, one for a top and the other for a bottom. This is very much a guerrilla approach because the buy alert indicated by the dashed arrow was signaled almost at the top of the rally. This example demonstrates the importance of picking and choosing between signals, only selecting those that develop close to a turning point. If this filtering approach is not taken, then there is considerable risk that action will be taken close to the end of the trend. A useful method that greatly reduces such whipsaw activity, but still offers timely signals, is to lag the 52-week EMA by 10 weeks when the trend deviation calculation is being made. This means that each weekly close is divided by the 52-week EMA as it appeared 10 weeks before. This new calculation has been plotted in the center panel of chart 14.16. In this example, the whipsaw in late 2000 was filtered out since the trend deviation indicator fails to cross decisively below its MA. I am not suggesting this is the only legitimate combination for weekly charts, but it is one that appears to operate quite well. There is always a trade-off when you try to make signals less sensitive, and in this case, we find that there is occasionally a small delay compared to the non-lagged 52-week MA. The most obvious one on this chart developed at the beginning of 1997, where the lagged series in the center panel crossed its M at a slightly higher price. In most instances, though, this is a small price to pay if a costly whipsaw can be avoided. MACD. The moving average convergence divergence MACD trading method is a form of trend deviation indicator using two exponential moving averages, the shorter being subtracted from the longer. The two MAs are usually calculated on an exponential basis, in which more recent periods are more heavily weighted than in the case of a simple MA. It is normal for the MACD to then be smoothed by a third exponential moving average MA, which is plotted separately on the chart. This average is known as the signal line, the crossovers of which generate buy and sell signals. It obtains its name from the fact that the two EMAs are continually converging and then diverging from each other. The MACD has gained great popularity over the years, but in effect, it is really just another variation on a trend deviation indicator that employs two EMAs as its method of deviation. A visual of its construction is therefore very similar to chart 14.13. MACDs can be used in an infinite number of time periods. Gerald Appel of Signalert, who has done a considerable amount of research on the subject, recommends that buy signals on a daily chart be constructed from a combination of 8, 17, and 9 exponential MAs, but he feels that sell signals are more reliable when triggered on the basis of a 12, 25, and 9 combination. On the other hand, the popular Metastock program plots the default values as 12 and 26 with the signal line at 9. Chart 14.17 shows Microsoft in 2011 and 2012. The dotted arrows indicate whipsaw signals, and the long arrows indicate those signals that were confirmed with a trendline break of some kind. General Electric is shown with a MACD indicator in chart 14.18. Another technique is to construct overbought, oversold lines, trend lines, and price patterns, and to look for divergences. In chart 14.18, for instance, both series complete head and shoulders patterns at the end of the year 2000. The MACD also experiences a negative divergence. Note how the divergence, flagged by the right shoulder, is barely able to rally above zero. The result is an above-average decline. Note also that the indicator remained below the equilibrium point and touched its oversold level several times during the balance of the period covered by the chart. This type of action reflects bear market activity. The MACD often works well with monthly data. In this respect, we look at the CRB Spot Raw Industrial Commodity Index in chart 14.19, where the solid arrows indicate good primary trend momentum buy signals. The two dashed ones indicate smaller rallies, which fall into the failure category. The MACD is often plotted in a histogram format, and the signal line against it, as in chart 14.20 featuring Homestake Mining. The chart shows a classic head and shoulders pattern. Note that the MACD histogram gradually became weaker as the pattern progressed. This was only a short-term sell signal, but the price eventually fell below the signal level. Stochastics. The stochastic indicator has also gained a great deal of popularity among futures traders, with the result that the standard formula uses very short-term time spans. The theory behind the indicator, which was invented by George Lane, is that prices tend to close near the upper end of a trading range during an uptrend. As the trend matures, the tendency for prices to close away from the high of the session becomes pronounced. In a downward moving market, the reverse conditions hold true. The stochastic indicator, therefore, attempts to measure the points in a rising trend at which the closing prices tend to cluster around the lows for the period in question, and vice versa, since these are the conditions that signal trend reversals. It is plotted as two lines, the %K line and the %D line. The %D line is the one that provides the major signals and is, therefore, more important. The formula for calculation of %K is %K equals 100 times, where C is the most recent close, L5 is the lowest low for the last 5 trading periods, and H5 is the highest high for the same 5 trading periods. Remember that the calculation of stochastic indicators differs from that of most other momentum indicators in that it requires high, low, and closing data for the calculation. The stochastic formula is similar to the RSI in that the plots can never exceed 0 or 100, but in this case, it measures the closing price in relation to the total price range for a selected number of periods. A very high reading in excess of 80 would put the closing price for the period near the top of the range, while a low reading under 20 would put it near the bottom of the range. The second line, %D, is a smoothed version of the %K line. The normal value is 3 periods. The %D formula is as follows: %D equals 100 times H3 divided by L3, where H3 is the 3-period sum of C minus L5, and L3 is the 3-period sum of H5 minus L5. The momentum indicator that results from these calculations is two lines that fluctuate between 0 and 100. The %K line is usually plotted as a solid line, while the slower %D line is usually plotted as a dashed line. The popularity of the stochastic indicator can no doubt be explained by the smooth manner in which it moves from an overbought to an oversold condition, lulling a trader into feeling that price trends are much more orderly than would appear from an observation of an RSI or an ROC indicator. Longer-term time frames, used on monthly and weekly charts, appear to work much better than the shorter-term stochastics used on daily futures charts. Colby and Mayers, in the Encyclopedia of Technical Market Indicators, McGraw-Hill, 2002, noted that the stochastic indicator tested very poorly relative to EMA crossovers and other momentum indicators. Overbought and oversold bands for the stochastic are usually plotted in the 75 to 85% area on the upside and in the 15 to 25% area on the downside, depending on the time span in question. An overbought indication is given when the %D line crosses the extreme band, but an actual sell alert is not indicated until the %K line crosses below it. When the two lines cross, they behave very similarly to a dual EMA system. If you wait for the penetration, you can avoid getting trapped into shorting a strongly bullish move or buying an extremely negative one. The behavior of the indicator will depend very much on the selected time frames. Since the %K and %D can be thought of as moving averages, it follows that the longer the time span, the smoother the resultant indicator. The upper panel of chart 14.21 shows a very volatile 5-5 combination, whereas the lower window contains a 3100 combination. Note that the %K is much less volatile than that in the upper window. The same is true for the 100 parameter used in the %D. However, it is so flat that it is essentially useless from the point of view of reflecting the cyclic rhythms. In reality, one would never use such a combination. Slowed stochastic. It is also possible and desirable to extend the calculation in order to invoke a slowed version of the stochastic. In this instance, the %K line is replaced with the %D line, and another EMA is calculated for the %D. Many technicians argue that this modified stochastic version gives more accurate signals. It certainly results in a more deliberate action. A comparison between a regular and a slowed stochastic is featured in chart 14.22. The 5-5 in the upper window legend refers to a 5-period for the %K and D, respectively. The 5 in the middle of the lower window legend refers to the slowing factor. Chart 14.22 compares a regular stochastic to a slowed one. General interpretation. Crossovers. Normally, the faster %K line changes direction sooner than the %D line. This means that the crossover will occur before the %D line has reversed direction, as in Figure 14.2. Divergences. Figure 14.3 shows examples of where the %K fails to confirm a new high or low in the price, thereby setting up a divergence, which when confirmed, signals a change in trend. Divergence failure. An important indication of a possible change in trend arises when the %K line crosses the %D line, moves back to test its extreme level, and fails to cross the %D line, as in Figure 14.4. Once again, it is always important to see some price confirmation, and that is given with the break above the downtrend line in the right side of the diagram. Chart 14.23 shows some examples of divergence failures, 2 confirmed bearish ones and 1 unconfirmed bullish one. Reverse divergence. Occasionally during an uptrend, the %D line will make a lower low, which is associated with a higher low in the price, as shown in Figure 14.5. This is a bearish omen, and conventional wisdom suggests looking for a selling opportunity on the next rally. This condition is sometimes referred to as a bear setup. A positive reverse divergence is featured in Figure 14.6. Extremes. Occasionally, the %K value reaches the extreme of 100 or 0. This indicates that a very powerful move is underway, since the price is consistently closing near its high or low. If a successful test of this extreme occurs following a pullback, it is usually an excellent entry point. Hinge. When either the %K line or the %D line experiences a slowdown in velocity, indicated by a flattening line, the indication is usually that a reversal will take place in the next period. Examples are shown in Figure 14.7 and Chart 14.24 in the form of a 10-minute chart for Pfizer. Slowing it down for better signals. It is often a useful idea to tweak the parameters to obtain a slower moving indicator where %K and %D crossovers can be used to good effect. Chart 14.25, featuring the S&P composite, shows a 20-20-20 and a 20-10-10 combination. Both show divergences, but the smoother series experiences just one whipsaw, whereas the 20-10-10 variety experiences 3. The trade-off is that the more volatile series triggers crossovers on a timelier basis. Finally, we move up to the monthly charts, where the 24-15-10 combination in Chart 14.26 really comes into its own. This combination, in most cases, will reflect primary trend swings in a fairly good way. For example, there is a positive stochastic crossover at the end of the 2000 to 2002 bear market confirmed with a nice trendline violation. There was another buy signal confirmed in 2006. Finally, a sell signal in late 2007 was essentially confirmed simultaneously with a trendline penetration. Summary. 1. The RSI is bounded by 0 and 100. Overbought and oversold lines should be wider as the time span gets shorter. 2. The RSI lends itself more easily to comparing the momentum of different securities than does the ROC. 3. The RSI can be used in conjunction with overbought and oversold lines, divergences, price patterns, trend lines, and smoothings. 4. Trend deviation indicators are calculated by dividing the close or a short-term EMA by a longer-term one. 5. Trend deviation indicators can be used with trend lines, price patterns, and EMAs. They also lend themselves to overbought, oversold, and divergence analysis. 6. The MACD is a form of trend deviation indicator. 7. The stochastic indicator assumes that prices close near the low at the end of a rally and near their highs at the end of a downtrend. 8. The stochastic indicator is confined between 0 and 100 and consists of 2 lines, the %K and the %D. 9. Stochastic indicators lend themselves to crossovers, divergences, hinges, extremes, and reverse divergences, and are usually plotted in their slowed version. Chapter 15. Momentum 3, Individual Indicators, Summed ROC, No Sure Thing KSD. The long-term KSD. We are going to start off this KSD explanation by discussing an indicator suitable for price swings associated with primary trends or those that revolve around the so-called 4-year business cycle, subsequently turning to its application for intermediate and short-term trends. Chapter 13 explained that rate of change, ROC, measures the speed of an advance or decline over a specific time span, and is calculated by dividing the price in the current period by the price in periods ago. The longer the time span under consideration, the greater the significance of the trend being measured. Movements in a 10-day ROC are far less meaningful than those calculated over a 12 or 24-month time span, and so forth. The use of an ROC indicator helps to explain some of the cyclical movements in markets, often giving advance warning of a reversal in the prevailing trend. But a specific time frame used in an ROC calculation reflects only one cycle. If that particular cycle is not operating, is dominated by another one, or is influenced by a combination of cycles, it will be of little value. Major technical principle. At any one time, price is determined by the interaction of many different time cycles. An indicator that takes this into consideration is likely to be timelier without losing too much in the way of sensitivity. This point is illustrated in Chart 15.1, which shows 3 ROC indicators of different time spans: 9 months, 12 months, and 24 months. The 9-month ROC tends to reflect all of the intermediate moves, and the 24-month series sets the scene for the major swings. The arrows flag the important turning points in this period. They show that, for the most part, all 3 ROC indices are moving in the same direction once the new trend gets underway. A major exception occurred at the 1984 bottom. Here we see the price rise, but immediately after, the 24-month ROC declines while the others continue on up. During the period covered by arrow A, the speed of the advance is curtailed because of the conflict between the 3 cycles. Later on, though, all 3 ROC indices get back in gear on the upside, and the rally approximated by arrow B is much steeper. In effect, major turning points tend to occur when several cycles are in agreement, and speedy advances and declines develop when more cycles are operating in the same direction. Even this is a fairly limited view because there are far more than 3 cycles operating at any one point in time. Clearly, one ROC time span taken on its own does not give us a complete picture. This was one of the factors considered in the design phase of the KSD. Another requirement was an indicator that fairly closely reflected the major price swings over the time period under consideration: primary trends for monthly charts, short-term trends for daily charts, and so forth. Chart 15.2 shows the S&P during the 1980 to 2012 period. The oscillator is a 24-month ROC smoothed with a 9-month MA. This series certainly reflects all of the primary trend swings during this period. However, if we use the indicator's changes in direction as signals, close examination shows that there is a lot to be desired. For example, the 1984 low is signaled with a peak in the oscillator. Similarly, the 1989 bottom in the momentum series develops almost at the rally peak. Also, the 1998 low was signaled with a peak in the oscillator, and the 2005 momentum peak was clearly premature. What is needed, then, is an indicator that reflects the major trend, yet is sensitive enough to reverse fairly closely to the turning points in the price. We are never going to achieve perfection in this task, but a good way of moving toward these goals is to construct an indicator that includes several ROC indices of differing time spans. The function of longer time frames is to reflect the primary swings, while the inclusion of the shorter ones helps to speed up the turning points. The formula for the KSD is as follows. Since the most important thing is for the indicator to reflect the primary swings, the formula is weighted so that the longer, more dominant time spans have a larger influence. Chart 15.3 compares the performance of the smooth 24-month ROC to the long-term KSD between 1974 and 1990. It is fairly self-evident that the KSD reflects all of the major swings being experienced by the smooth 24-month ROC. However, the KSD turning points develop sooner than those of the ROC. The vertical arrows slice through the ROC as it bottoms out. In every instance, the KSD turns ahead of the arrow, the lead time varying with each particular cycle. Note how in 1988 the KSD turns well after the 1987 bottom, but just at the time when the market begins to take off on the upside. The ROC reverses direction much later. There is one period when the KSD underperformed, and that is contained within the 1986-1987 ellipse, where the KSD gave a false signal of weakness, unlike the ROC, which continued on up. The dominant time frame in the KSD's construction is a 24-month period, which is half of the so-called 4-year business cycle. This means that it will work best when the security in question is experiencing a primary uptrend and downtrend based on the business cycle. For example, Chart A circumflex Euros 15.4 shows the KSD during the 1960s and 1970s, where the S&P was in a clearly defined business cycle type trading range. Periods of accumulation and distribution occur between the time when the KSD and its moving average MA change direction. There are really 3 levels of signaling. The first occurs when the indicator itself changes direction, the second when it crosses its 9-month MA, and the third when the EMA itself reverses direction. In most cases, the EMA crossover offers the best combination of timely signals with a minimum of whipsaws. Changes in the direction of the 9-month EMA offer the most reliable signals, but these usually develop well after the turning point. The timeliest and most reliable signals thereby develop in those situations where the EMA reverses close to a turning point. If it does not, this event should merely be interpreted as a confirmation of a move that is already in progress. For the most part, the KSD has been reasonably reliable, but like any other technical approach, it is by no means perfect. For instance, the same calculation is shown in Chart 15.5, but this time for the Nikkei. During periods of a secular or linear uptrend, as occurred for Japanese equities in the 1970s and 1980s, this type of approach is counterproductive since many false bear signals are triggered. However, in the vast majority of situations, prices do not experience such linear trends, but are sensitive to the business cycle. It is for this reason that I call this indicator the KSD. The letters stand for no sure thing, KSD. Most of the time, the indicator is reliable, but you know that it's not a sure thing. Major technical principle. The KSD should always be used in conjunction with other indicators. The principles of interpreting the long-term KSD are the same as any other oscillator, though its default technique is to observe positive and negative EMA crossovers. Occasionally, it's possible to construct trend lines and even observe price patterns, as well as conduct overbought-oversold analysis. Short and intermediate-term KSDs. The KSD concept was originally derived for long-term trends, but the idea of 4 smoothed and summed ROCs can just as easily be applied to short-term, intermediate, and even intraday price swings. Formulas for various time frames are presented in Table 15.2. These are by no means the last word and are suggested merely as good starting points for further analysis. Readers may experiment with different formulas for any of the time frames and may well come up with superior results. When experimenting, strive for consistency, never perfection, for there is no such thing in technical analysis. Chart 15.6 shows an intermediate KSD for the US dollar index. The dark highlights indicate when the KSD is above its 10-week exponential moving average EMA, and the lighter plots when it is below. 2 round-trip signals have been flagged with the arrows to demonstrate this. The principle of countercyclical trends being weak and the danger of trading them can also be appreciated from this chart. The 3 small arrows in the 2007 to 2008 period indicate bullish signals that ran counter to the main trend, which was negative. All 3 were short-lived and lost money. Chart 15.7 features the London copper price. One of the things I like about the indicator, especially in its short-term and intermediate varieties, is its flexibility of interpretation. Nearly all of the interpretive techniques discussed in Chapter 13 can be applied. In Chart 15.7, for example, we see an overbought crossover at the tail end of 1994. It did not amount to anything because it was not possible to come up with any trend reversal signals in the price. Later on, though, in early 1995, we see a negative divergence, and at the end of the year an overbought crossover, a 65-week EMA crossover, and a head and shoulders top in the price. Classic stuff. There were a couple of false buy signals on the way down, but the rally peaks in the KSD lent themselves to the construction of a nice downtrend line. The violation of the line, the oversold crossover, and the completion of the base in the price combined together to offer a nice buy signal in late 1996. The next time the KSD crossed its oversold level in 1998, there was no good place to observe a trend reversal signal in the price. That was not true in early 1999, where a positive divergence, EMA crossover by the KSD, and a trendline break in the price offered a good timely entry point. Note that after the price broke above the downtrend line, it subsequently found support at the extended line. Chart 15.8 features the Global XFC Colombia ETF with a daily KSD. It demonstrates the fact that this series has the occasional ability to trace out price patterns, as it does in late 2010. Note also the bear market that began late in that year, and the inability of the KSD to rally much above the equilibrium level. Major technical principle. Sometimes, a study of the characteristics of an oscillator can be helpful in identifying the direction of the primary trend. Weak rallies indicate bear markets, and weak reactions indicate primary uptrends. Note also the ability of the KSD to signal divergences, such as the negative discrepancy in early 2012. Chart 15.9 shows the same information as its predecessor, but this time the solid arrows flag positive and negative overbought-oversold crossovers that were confirmed by the price. The failed dashed arrows show the value of waiting for such signals to be confirmed by the price. Major technical principle. The first rule in using the short-term KSD is to try to get a fix on the direction and maturity of the primary trend, and never trade against it. Identifying the direction of the main trend is easier said than done. However, if you pay attention to the price relative to its 65-week or 12-month M, and the level and direction of the long-term KSD, or special K explained later in this chapter, you will at least have an objective measure of the primary trend environment. Chart 15.10, featuring Indian hotels, again brings out the concept of constructing overbought and oversold lines and seeing what happens when the KSD reverses from such levels. In this exercise, I am not concentrating on confirmations, but in qualifying the distinction between the generation of pro and contra-trend signals. The solid arrows indicate pro-trend signals, and the dashed ones indicate contra-trend signals, using the KSD in the market cycle model. 3 main trends. Earlier chapters explained that there are several trends operating in the market at any particular time. They range from intraday, hourly trends right through to very long-term or secular trends that evolve over a 19 or 30-year period. For investment purposes, the most widely recognized trends are short-term, intermediate-term, and long-term. Short-term trends are usually monitored with daily prices, intermediate-term with weekly prices, and long-term with monthly prices. A hypothetical bell-shaped curve incorporating all 3 trends is shown in Figure 1.1. From an investment point of view, it is important to understand the direction of the main, or primary, trend. This makes it possible to gain some perspective on the current position of the overall cycle. The construction of a long-term KSD is a useful starting point from which to identify major market cycle junctures. The introduction of short-term and intermediate series then allows us to replicate the market cycle model. The best investments are made when the primary trend is in a rising mode, and the intermediate and short-term market movements are bottoming out. During a primary bear market, the best selling opportunities occur when intermediate and short-term trends are peaking and the long-term series is declining. In a sense, any investments made during the early and middle stages of a bull market are bailed out by the fact that the primary trend is rising, whereas investors have to be much more agile during a bear market in order to capitalize on the rising intermediate-term swings. Combining the 3 trends. Ideally, it would be very helpful to track the KSD for monthly, weekly, and daily data on the same chart, but plotting constraints do not easily permit this. It is possible, though, to simulate these 3 trends by using different time spans based on weekly data, shown for the S&P European 350 ETF in Chart 15.11. Note that the formula for the short-term KSD differs from its daily counterpart in that the time spans, see Table 15.2, are longer, and the formula, like all 3 included on the chart, uses EMAs rather than the simple moving average. This arrangement facilitates identification of both the direction and the maturity of the primary trend, shown at the bottom, as well as the interrelationship between the short-term and the intermediate trends. The dark plot shows when the long-term KSD is above its 26-week EMA and the lighter plot when it is below. Sometimes, KSD primary trend signals coincide with the price itself crossing its 65-week EMA, as was the case in December 2007 and August 2009. The chart also shows the approximate trading bands for the short-term KSD in bull and bear markets, as defined by the long-term KSD EMA crossover approach. Note how it rarely moves to the oversold zone during the bullish environments, and rarely to the overbought zone when the main trend is down. The best buying opportunities seem to occur either when the long-term index is in the terminal phase of a decline, or when it is in an uptrend, but has not yet reached an overextended position. Quite often, the long-term series stabilizes but does not reverse direction, thereby leaving the observer in doubt as to its true intention. Vital clues can often be gleaned from the action of the short-term and intermediate series, in conjunction with the price action itself. For example, it is unusual for the intermediate series to remain above or below equilibrium for an extended period, say, more than 9 months to a year. Consequently, when it falls below zero after a lengthy period of being above it, this argues for a bearish resolution to a flat long-term series and vice versa. A sell signal of this nature was triggered in early 2008 after the intermediate KSD had been above zero for over 4 years, although you can't see all of that from this chart. Note also the mega overbought reading in the short-term series that developed in 2009. It was actually the highest reading since the inception of this ETF in the year 2000. The KSD can be plotted for free at www.pringcom in this market cycle format for any Yahoo symbol, whether US or international. The KSD and relative action. The KSD can also be adapted to relative strength lines and is especially useful for long-term primary trend analysis when applied to industry groups or individual stocks. This is because sector rotation develops around the business cycle as different groups are coming in and out of fashion. As a result, linear uptrends and downtrends are far less likely to develop than with absolute price data. For a fuller discussion on these matters and KSD applications, see chapters 19 and 22. Are there KSD substitutes? The KSD is not the only answer to our smoothed momentum problems, since it is also possible to substitute the moving average convergence-divergence MACD using the default parameters, or the stochastic using a 24-15-10 combination, in the likely event that your charting software does not carry the KSD or the ability to replicate it. Those same parameters for the stochastic appear to work for all 3 time frames. Chart 15.12 compares the 3 indicators using monthly data. Note that in most cases, the KSD coincides with or leads turning points in the stochastic. The dashed arrow indicates when the stochastic led. Alternatively, the more sensitive MACD often gives false impressions of trend reversals that either turn out to be false or are reversed before a crossover of the signal line takes place. For these reasons, I prefer the KSD for all trends, not just long-term ones. It may well be possible to come up with superior parameters for both indicators, and the reader is certainly encouraged to make an attempt to do so. The special K. An alternative method of charting the KSD comes when all 3 of them are combined into one indicator, which I call the special K. This gives us true summed cyclicality where the short, intermediate, and long-term trends are combined into one super one. The calculation is made by adding the daily KSD formula to that of the intermediate and long-term series based on daily data. Thus, say the 12-month time span used in the long-term KSD calculation is replaced by 265 days as an approximation for the trading days in a calendar year. Table 15.3 contains the formula, and Figure 15.1 features the concept in a visual format. It is really a practical adaptation of the dashed line short-term trend in Figure 15.1. It also contrasts the slow, deliberate path of the long-term KSD with the more jagged trajectory of the special K. In an ideal world, the special K ought to peak and trough more or less simultaneously with the price at bull and bear market turning points. In most situations, that actually happens. When it does, the trick is being able to identify these turning points as quickly as possible. The usual caveat with premature momentum turning points developing in linear uptrends or downtrends still applies. The prime function of the special K, then, is to identify primary trend turning points. Since this indicator also includes short-term data in its calculation, a subsidiary benefit lies in identifying smaller trends and putting that in context with the direction and maturity of the primary trend. Using the special K to identify long-term price movements. The following are some of the special K characteristics. 1. The special K is a curve that reflects the dominant long-term KSD, but is not as smooth since it also contains data that reflects short-term and intermediate price movements. 2. Primary trend peaks and troughs in the price itself often coincide simultaneously with those of the special K. Where linear uptrends or downtrends are present, the special K, SPK, leads such turning points and sets up a divergence. The arrows on chart 15.13 show some of these turning points for the S&P composite. Note that in 1998 the SPK peaked prematurely due to the presence of a secular uptrend in U.S. equities. There are even more examples in chart 15.14 of the CRB composite. Of the 12 peaks and troughs between 1983 and 2012, only one did not develop simultaneously with the SPK. 3. This indicator lends itself to trendline construction. Usually, when lines greater than 9 months in duration are penetrated, there is a high probability that the primary trend has reversed. This is demonstrated in chart 15.15 for the S&P composite, where we see several SPK trendline penetrations confirmed by a similar action by the price. Occasionally, the trend is so steep that it is impossible to construct a meaningful trend line. In such cases, joint moving average crossovers between the price and SPK that develop within a short time of each other usually serve as timely signals. A joint EMA crossover takes place along with some trendline violations, but the rally off the 2009 bottom would have been signaled with the EMA cross approach. The EMA for the price has a 200-day span, and the one for the SPK has a 100-day span smoothed by an additional 100-day EMA. Chart 15.16 also shows some joint EMA breaks at points A, B, and C, as well as numerous trendline combinations. Note that occasionally the SPK will trace out a small trading range, and when this has been completed, reversal signals are triggered. The 2007 and 2010 lows offer 2 examples of this phenomenon. 4. Peak and trough reversals often show up at primary trend turning points. We see 3 instances in chart 15.17 for the Bombay Stock Exchange FMGC index at points X, Y, and Z. Not all turning points are signaled in this way, just as it's not always possible to construct a meaningful trend line. However, if we see a trend break and an obvious peak/trough reversal, the odds of a primary trend reversal are greatly enhanced. Using the special K to identify short-term price movements. If you compare movements in the daily KSD in chart 15.18 with those of the special K, you will see that they are very close indeed, which means that we really do get the summed cyclicality of that dashed short-term trend curve in our original market cycle diagram, figure 1.1. That means we can use its gyrations to help identify short-term reversals in the special K. For example, if the KSD is overbought and reversing, as in October 2007, it is more likely to result in an imminent reversal in the trajectory of the special K, and therefore, the price. The oversold reading that preceded it in August 2007 also worked quite well. However, during May 2007, we get another KSD overbought reversal. The special K also reverses, but there is no immediate decline. The reason? It's because this sell signal was a contra-trend one, as the prevailing primary trend was bullish. Chart 15.19, featuring the CRB composite, also displays the daily KSD in the bottom window. We see an overbought KSD with a reversing special K in May 2000, and this is followed by a 3-month correction. However, there is more to it than that. Most of the time when the KSD reverses direction, the special K does as well. However, when the KSD reverses to the upside, for example, and there is very little or no special K response, the chances are that bearish intermediate and long-term forces are dominating, thereby putting substantial downward pressure on the special K. Under such circumstances, the special K is most likely going to move lower once the daily KSD rally is over, thereby confirming that the main trend remains bearish. Several examples of this phenomenon are seen in the chart, the most glaring of which developed in the August-September 2001 period when the KSD experienced a gentle rally, but the special K continued in its decline with no sign of strength whatsoever. This weakness was not apparent by observing the action of the daily KSD, but by comparing it to the weak action of the special K, it was possible to appreciate the downside pressure being applied by the intermediate and long-term cycles. Another small discrepancy developed in July 2001, where the Special K was hardly able to rally at all. The April-May 2001 period also shows a strong KSD rally, but a very weak Special K advance. Bullish divergences develop when the KSD declines, but the dominant longer-term cycles used in the Special K calculation propel it upward. A good example developed in November 2002 and January 2003, as indicated by the two solid arrows. The idea of rising peaks and troughs for the Special K is especially important because it indicates strength in the dominant intermediate and primary trend cycles. For example, look at the two dashed arrows. The one for the KSD shows a lower low in November 2002, and that for the Special K shows a higher trough, if you can call it that, at B. Finally, there is another way in which the near-term movements can help in deciding whether a specific short-term KSD buy or sell signal is going to work or not. Note the horizontal dashed line marking the short-term low in the Special K in May 2001. When the indicator violates this level, it signals that a new low in the price itself is likely. In the case of the May 2001 example, the Special K took out its low just about 2 weeks before the CRB itself did. The reverse situation developed in November 2002, where the Special K moved to a new high. In this case, there was no lead by the momentum indicator as the price broke out more or less simultaneously with it. Major technical principle. If the Special K registers a new high or low for the move, the price usually follows. How the Special K generates short-term buy and sell signals, one of the most important things for short-term traders to grasp, is the fact that major technical principle. Trades executed in the direction of the main trend are much more likely to be successful than those generated in a countercyclical way. One starting point that helps us arrive at an objective way of determining the direction of the primary trend is to use the SPK. Obviously, we can easily tell with the benefit of hindsight where the actual SPK peaks and troughs formed, but in real time, we do not have this luxury. One solution is to determine its position vis-a-vis its 100-day MA smoothed with a 100-day MA. Positive readings would indicate a primary bull market, and vice versa. Chart 15.20 shows such a system for the Dow Jones UBS Commodity Index. The shaded areas represent bear markets as defined by the SPK-EMA relationships. No signals are generated during this type of environment. The dark highlights indicate when the SPK crosses above its 10-day EMA and when the primary bull-bear model is bullish. This approach is far from perfect because there are points when the model is bullish, but the price has already reversed, and so forth. Rather than blindly using this approach as a mechanical system, I think it better to use pro-trend signals as an alert, and to then use other indicators as a filter in a weight of the evidence approach. Self-generated charts and templates for these SPK systems are included in an add-in package for Metastock, which is available at www.pring.com. Special K drawbacks and benefits. Like all momentum indicators, the SPK does come with drawbacks. The most noticeable derives from the fact that the indicator's construction assumes that the price series in question is revolving around the typical business cycle. Consequently, it reverses prematurely during linear trends and will lag when the cycle is unusually brief. That is, of course, a drawback with any long-term momentum indicator. However, in the few years I've been working with it, I've grown more and more impressed with its ability to identify numerous primary trend turning points where other indicators have failed. The directional movement system. The objective of the directional movement system, designed by Wells Wilder, is to determine whether a market is likely to experience a trending or trading range environment. The distinction is important because a trending market will be better signaled by the adoption of trend-following indicators, such as moving averages, whereas a trading range environment is more suitable for oscillators. In practice, I am not impressed with the ability of the directional movement system to accomplish this objective, other than to identify a change in trend. On the other hand, there are, I find, several other ways in which this indicator can be usefully applied. The calculation of the directional movement system is quite involved, and time does not permit a full discussion here. For that, readers are referred to Wilder's New Concepts in Technical Trading Systems, Trend Research, 1978, to my own definitive guide to momentum indicators book and CD-ROM tutorial marketplace books, 2009, or to my online audio-visual technical analysis course at pring.com. To simplify matters, the directional movement indicator is plotted by calculating the maximum range that the price has moved, either during the period under consideration day, week, 10-minute bar, etc., or from the previous periods close to the extreme point reached during the period. In effect, the system tries to measure directional movement. Since there are two directions in which prices can move, there are two directional movement indicators. They are called plus die and minus die. The resultant series is unduly volatile, so each is calculated as an average over a specific time period and then plotted. Normally, these series are overlaid in the same chart panel, as shown in chart 15.21 for the euro using the standard, or default, time span of 14 periods. There is one other important indicator incorporated in this system, and that is the average directional movement X. The ADX is simply an average of the plus and minus die over a specific period. In effect, it subtracts the days of negative directional movement from the positive ones. However, when the minus die is greater than the plus die, the negative sign is ignored. This means that the ADX only tells us whether the security in question is experiencing directional movement or not. Again, the normal default time span is 14 days. The ADX is calculated in such a way that the plot is always contained within the scale of 0 to 100. High readings indicate that the security is in a trending mode, i.e., it has a lot of directional movement, and low readings indicate a lack of directional movement and are more indicative of trading range markets. Major technical principle. The ADX tells us nothing about the direction in which a price is moving, only its trending or non-trending characteristics. The two dis. In chart 15.21, buy alerts are signaled when the plus die crosses above the minus die solid arrows and vice versa dashed arrows. In this example, there are several occasions when it is possible to confirm such crossovers with a trendline violation in the price. Moving average crossovers or price patterns could just as easily be substituted. These die crossovers are fairly accurate and not subject to whipsaws. Unfortunately, things do not always work out as well, which you can see from the whipsaw signals in the 5 ellipses in the bottom window of chart 15.22. That's one reason why it is important to make sure that these crossovers are confirmed by the price. Another way around this is to smooth the two die as I have done in the middle panel of chart 15.22, using a 10-day MA. This certainly eliminates a lot of the whipsaws, as you can see from the ellipses, but there is a trade-off in that the signals are occasionally delayed because this approach is less sensitive. In this instance, I have placed arrows at some of the key points where the smooth series cross each other. Again, it's important to remember that these are momentum signals and should be confirmed by the price. In addition, this approach, like most others, should be used where you decide to fight the battle. That means that if the price has already moved a long way by the time the signal has been triggered, it is probably best to ignore it for new positions. The X. A high ADX reading does not tell us that the market is overbought and about to go down. Instead, it measures the intensity of the move from a directional point of view. Consequently, when it reaches a high reading and starts to reverse, a warning is given that the prevailing trend has probably run its course. From here on in, we should expect it to change. This is different from a reversal in trend, since a change in trend could also be from up to sideways or down to sideways. In chart 15.23, a 14-day ADX has been plotted against the Gold Trust ETF, the GLD. Note how reversals from high reading signal turning points at both tops and bottoms. Since the upward and downward trajectories are fairly deliberate, negative 10-day EMA crossovers at high ADX readings act as good confirmation that a peak has been seen. The indicator in the bottom panel is simply the differential between a 10-day EMA of a 14-day plus die and a minus die, as shown in the center panel of chart 15.22. By comparing the position of the ADX to the differential, it is fairly obvious whether a high-end reversal is coming from an overbought or oversold level. When the ADX reverses in such a manner, it's then a good idea to obtain some kind of price confirmation. Of the 3 instances in this chart, only the first in September 2011 was confirmed. Low readings in the ADX indicate a lack of directional movement. These can be helpful as well when it is fairly clear that a new rising trend of directional movement from such a benign level is underway. In this respect, the differential indicator traced out a reverse head and shoulders in the late summer of 2012, just as the ADX was crossing above its M from a subdued level. The low ADX reading told you there was no directional movement and to be prepared for some. In addition, the breakout from the base in the differential and trendline violation in the price said it would be an upward one. Summary. 1. The KSD can be constructed for any time frame, from intraday to primary. 2. It is calculated from the smoothed ROC of 4 time spans, each of which is weighted according to the length of its time span. 3. Long-term, short-term, and intermediate KSDs can be combined into one chart to reflect the market cycle model. 4. The KSD lends itself to numerous momentum interpretive techniques. 5. The KSD can successfully be applied to relative strength analysis. 6. The special K is a summation of the short-term, intermediate, and long-term KSDs and can be useful for identifying short-term and long-term trend reversals. 7. In most situations, the special K peaks and troughs very closely to primary trend turning points. 8. Trend reversals in the special K are signaled by trendline violations, moving average crossovers, and peak-trough progression reversals. 9. The plus die and minus die measure positive and negative short-term direction. They can be smoothed to eliminate whipsaws and can be differentiated to result in a timely oscillator. 10. When the raw or smooth die cross, they trigger buy and sell momentum signals. 11. The ADX measures the directional movement of a trend. 12. A rising ADX indicates an increase in directional movement and vice versa. 13. When the ADX reverses direction from a high reading, the prevailing trend is likely to change. Chapter 16. Candlestick Charting. Candle Construction. The candlestick form of charting began to gain popularity in the 1990s. This method originated in Japan several centuries ago and basically offers the same information as bar charts. The difference is that candlestick charts can often make it easier to spot certain technical phenomena not readily apparent with a quick glance at a bar chart. Bar and candlestick charts are compared in figures 16.1 and 16.2. Though candlesticks can be plotted for any period from minute to monthly, I will use the term daily as a generic reference in this chapter to eliminate repetition. Candlestick charts can only be plotted for markets in which opening prices as well as closes, highs, and lows are known. One disadvantage is that they take up a lot of horizontal space, which limits the amount of data that can be physically displayed. Fortunately, trend reversal signals tend to be very short-term in nature, with their effects generally lasting for a few days and rarely more than 3 weeks. Candlestick charts offer indications of both reversal and continuation phenomena, just as bar charts do. Some examples in this chapter demonstrate these phenomena in candlestick formations. They really come into their own in the identification of shorter-term reversals and continuation situations. Candlesticks are certainly no magic wand, but they are unquestionably a useful technical tool for short-term traders. They consist of a vertical rectangle with 2 lines spiking up and down. The vertical rectangle is known as the real body and encompasses the trading activity between the opening and closing prices, figure 16.3. For example, if the opening price is higher than the closing price, it will be recorded at the top of the real body and the closing price at the bottom. The vertical line above the real body measures the distance between the high of the day and the higher of the opening or closing price. The lower line represents the distance between the low of the day and the lower of the opening or closing price. Days when the close is higher than the opening are represented by transparent white real bodies. Days when the opening is higher than the close are displayed by a solid black real body, figure 16.4. Even though candlesticks can be plotted for any period in which information is available, I use days in the example because daily candlestick charts are the most common. Major technical principle. In candlestick charting, the greatest emphasis is given to the opening and closing prices and the trading range between them. The thin vertical lines that protrude from the real body reflect the high and low for the day. These are known as upper and lower shadows or wicks. Since the closing and opening prices can be identical or identical with the high or low, a number of possible combinations need to be represented. Some of them are shown in figure 16.5. Candlesticks provide essentially the same information as bar charts, but their more pronounced visual representation of the material enables technicians to identify characteristics that are less obvious on bar charts. Certain phenomena illustrated in bar charts have been given their own names, such as key reversal days or island reversal days. Likewise, with candlestick charts, because of the large number of potential variations for both individual days and price formations encompassing several days, it has been common practice to give exotic names to the various possibilities. Basic candlestick pattern building blocks. The candlestick patterns in Figure 16.6 are among the most essential individual candlestick lines for building candlestick patterns. A doji is a trading session where the opening and closing prices either are the same or very close to each other. When dojis appear in trading ranges, they reflect an environment where buyers and sellers are temporarily in balance and are, therefore, of little significance. However, when they develop after an advance or decline, the appearance of a more balanced state between supply and demand is a vital clue that the trend may be about to change, since this state of implied balance follows a period in which either buyers rally or sellers decline, were previously in control. Finally, there is a spinning top. Small real bodies characterize them, where the shadows can be short or long. It is the size of the real body, rather than the shadow's size, that is important in identifying a spinning top. Spinning tops are not important when they appear in trading ranges, but they are significant when they develop as part of a price pattern, since they represent a battle between the bulls and the bears. Spinning tops indicate indecision, where participants cannot agree on whether prices should rally or react. When they appear after a prolonged rally or reaction, it is a sign that upside or downside momentum is dissipating. Putting it another way, we could say that in previous sessions, buyers or sellers had the upper hand, but the spinning top tells us the fight is more evenly matched. Thus, another small change in the balance between supply and demand could tip the price trend the other way. This is why a spinning top is an initial sign a trend may be in the process of reversing. Only when this is confirmed by other price action, which we shall get into later, should you take action. Figure 16.6 includes an umbrella line. The concept behind umbrella lines is that the opening and closing prices develop close to the high of the day. The real body in this case more closely resembles a square than a rectangle. Umbrellas tend to be bullish after a decline and bearish following an advance. If they develop within the confines of a trading range, they have no real significance. Belt hold lines Urakiri. A bullish belt hold, long white line in Figure 16.7a, is a one candlestick pattern consisting of a long white candlestick in which the price opens on the session low and then works its way higher throughout the session. The price does not have to close at the high, but the longer the real body, the more positive the candlestick. Also, if a belt hold has not appeared on the chart for quite a while, it is an unusual phenomenon, so it gains in importance when it does appear. This is because traders are making a very strong statement about their feelings toward the market with a belt hold, compared to the smaller candlesticks that were previously the norm. Just think of a crowd murmuring, and then a loud voice comes from within the crowd. It is obviously a person who wants to be heard. The belt hold following a long period of smaller candlesticks amounts to the same thing. It's a one-day pattern that says loudly, "Listen to me because I am telling you the short-term trend has changed." A bearish belt hold, the long black line in Figure 16.7b, is the opposite. It is a long black candlestick in which the price opens at the high and then works its way lower as the session progresses. Belt holds are often important pivotal days, since the high and low occasionally act as support and resistance areas in subsequent price action. The halfway point of the real body of a belt hold also should be monitored for a possible price reversal during later price swings. The upper and lower areas of belt holds are potential future support resistance levels. An example is shown in Chart 16.1. Candlestick patterns basically fall into two broad categories, reversal and continuation, so we will split our discussion into these respective parts, starting with the more interesting reversal phenomena. Candlesticks can be applied to any time frame, though when they appear on intraday charts, they do not have as much significance as on daily or weekly charts. Their effect, like that of bar charts, should only be expected to last for between 5 and 10 candles. Thus, it would be reasonable to expect a candlestick pattern on an hourly chart to last for 5 to 10 hours, and on a monthly chart for 5 to 10 months, and so forth. Reversal phenomena. Hammers and hanging men Takuri and Kibitsuri. These formations, figures 16.8 and 16.9, have probably gained more notoriety than all the others because of their imposing titles. A hanging man is an umbrella line that develops after a rally. The shadow should be at least twice the size of the real body. It looks rather like the body of a man with dangling legs and, as its name implies, is a bearish pattern. If a hanging man appears after a prolonged up move, it should be treated with respect, especially if it occurs after a gap. A hanging man can be identified by the fact that the shadow, or wick, is at least twice the height of the real body. The color of the body is not important. A hammer is identical to a hanging man, but occurs after a market decline, when it is a bullish sign. It gets its name from the idea that the price is hammering out a bottom. In effect, it represents the kind of trading day when the price temporarily slips quite sharply, for there is a run on the selling stops. Nevertheless, the technical position is sufficiently constructive to cause buyers to come into the market and push the price back up toward or above the opening level. It is always better to see some confirmation. In the case of a hanging man, this confirmation could take the form of a long black candlestick, as indicated in figure 16.8. An example of a hammer is shown in chart 16.1 for China. Note how the open and the close develop well above the day's low, thereby indicating seller exhaustion following a sharp setback. Dark cloud cover caboose. In real life, dark clouds, figure 16.10, hint at the possibility of rain, so a dark cloud candlestick formation implies lower prices. Its bearish connotations are most pronounced during an uptrend or in the upper part of a congestion zone. It is a form of key reversal, since the price closes down on the day after a gap higher opening. It consists of 2 days price action. First is a strong, white real body, and the second is a black body in which the open develops above the upper wick of the white candlestick, and the close occurs in the lower half of the previous white real body. An example is shown in chart 16.2. Normally, these patterns develop after a sharp rally where there are plenty of traders willing to take profits. This one also qualifies as an engulfing pattern, described later. Piercing line Kirikorni. This pattern, figure 16.11, would be more aptly named sunny sky, because it is the exact opposite of the dark cloud and is, therefore, bullish. It is important to note whether the second day's white body closes more than halfway above the previous body, with an opening price that traded below the lower wick of the previous black candlestick. Chart 16.3 shows a classic example at the October 2011 low in the S&P ETF, the SPY. Also see another example earlier that barely qualifies under the rule that states that the black candlestick should close more than halfway below the real body of the previous white candle. Chart 16.4 also shows a couple more instances of piercing white lines. Engulfing pattern Tsutsumi. This formation, figure 16.12 and 16.13, develops significance after a prolonged price move. It is characterized by 2 consecutive, relatively shadowless, real bodies in which the real body of the second day engulfs that of the first. It is bullish in a downtrend, when the second day is a white body, and bearish in an uptrend, when it appears as a black one. We are treated to a bearish engulfing pattern for the Global X Silver Mine ETF in chart 16.4. Even though this was a classic pattern, there was no way to forecast the enormity of the ensuing decline. Bullish engulfing pattern appears in chart 16.5. Stars Hoshi. Stars are common phenomena in candlestick charts and come in 4 different reversal varieties. They are combinations of wide real bodies and spinning tops. The morning star, figure 16.14, heralds a new day up move and is bullish. It consists of 2 long real bodies separated by a spinning top. The star is represented by the spinning top, which is made on a gap. The third body should be white and should result in a closing price being more than halfway up the body of the first. The evening star, figure 16.15, is a precursor of night. It has the opposite characteristics and implications of a morning star. An example appears in chart 16.3 for the S&P ETF in September 2012. Ideally, I would have liked to see a larger white real body as the first candlestick in the pattern, but it worked nevertheless. Candlestick patterns, like all technical phenomena, can and do fail from time to time, and stars are no exception. In this respect, figure 16.16 shows a failed bearish evening star as the white candlestick to the right takes the price above the spinning top. A cancellation of a morning star would develop in exactly the opposite way, with a black real body taking the price below the spinning top. A bearish evening doji star figure, 16.17 bullish, occurs after a lengthy rally. It consists of a gap and a doji line. An example appears in chart 16.4 and a bullish morning doji star in figure 16.18. A particularly wide trading range, where the opening and closing are more or less identical, is known as a long-legged doji. An example is shown in figure 16.19. Where it appears after a long white candlestick, it can be quite ominous. Shooting star figures 16.20 and 16.21 is like a short-term top. The daily price action experiences a small gap, where the real body appears at the end of a long wick or upper shadow. We see a couple of examples of bearish shooting stars in chart 16.5. Late September 2011 witnessed a classic shooting star, with two relatively large real bodies sandwiching a much smaller one. The October pattern, on the other hand, saw two relatively small real bodies surround an even smaller one and represents a bit of a stretch. The same comments could be applied to the shooting star in chart 16.4. A bullish shooting star is also featured in chart 16.6. Upside gap 2 Crow's Narabi Kuro. This bearish formation figure 16.22 consists of a long white line followed by two black lines. First black line gaps to the upside. The third day often closes the gap, but because it is a black line where the close is below the open, its implication is bearish. Three black crows Samba Garasu. The three black crows pattern figure, 16.23, consists of three declining black candlesticks, which form after an advance and indicate lower prices. Each candlestick should close at or near its session low. You can see that none of them have a lower wick, and each of the three real bodies opens within the range or right at the bottom of the previous session's real body. A good example is featured in chart 16.7 for Assier trading, tourism and manufacturing, a Middle Eastern stock. The first crow was a kind of shooting star, which in itself suggested that buyers had spent all their investment funds. Tweezer tops and bottoms Kenuki. If you hold a tweezer upside down, you will see that the 2 points are at identical levels, figure 16.24. The same is true of a tweezer top, which consists of two candlesticks, for which the high of the day is identical. Actually, it's possible for a tweezer to consist of more than 2 days with an identical top. Make no mistake about it, we are talking about the high, which can be a shadow or real body close or open. This pattern is short-term bearish because the first day's high acts as resistance, so when the second day is unable to punch through the horizontal line, which marks the area of the top, it indicates a loss of upside momentum. In this example, the second day is also an engulfing pattern, which is an important point, since a tweezer often contains a price pattern as part of its formation. A tweezer bottom occurs when, after a decline, two or more candlesticks make an identical low. This again indicates a loss of downside momentum since the price finds support in the area of the low. In this figure, we see a tweezer literally hammered out because the second low to touch the horizontal line is a part of a hammer candlestick. One factor that will increase the significance of a tweezer is the nature of the pattern being formed. For example, if the second day of a tweezer top is a hanging man, we would have two pieces of evidence that the trend may be about to reverse, the tweezer and the hanging man. If the top of a tweezer temporarily pushes through resistance, such as a meaningful trend line, this would emphasize the significance since it would indicate exhaustion. The same would apply to the temporary violation of a support trend line. You can see an example of a tweezer top in chart 16.6. Note how the tweezer resistance later on proved to be a barrier to a subsequent advance. That same chart also shows an example of a piercing white line, or is it a bullish engulfing pattern? It really does not matter what we call it because this is a bullish formation, and that's all that matters. Counterattack or meeting lines D-sen Jayakushu sen. A bullish counterattack line figure 16.25 develops when, after a decline, a black candlestick is followed by a white candlestick and both close or meet at the same level. This is why this 2-day pattern is sometimes referred to as a meeting line. The first day is usually a long black candlestick. The second day opens sharply lower, leading most traders to believe prices will continue to give way. However, by the end of the day, the price has regained everything lost to counterattack by the buyers and closes unchanged. The meeting line, therefore, indicates that the downside momentum has probably dissipated and a reversal in trend is likely. A bearish counterattack, or meeting line figure 16.26, is formed when, after an advance, a white candlestick is followed by a black candlestick and both close at the same level. The psychology behind this one is fairly evident. The sharply higher opening on the second day has the bulls in a euphoric mood since these new gains come on top of an already sharp rally. However, euphoria turns to disappointment as the price unexpectedly returns to the unchanged level. More specific rules for identifying these patterns are as follows. 1. The first day is colored in the direction of the prevailing trend, and the second day forms in the opposite color white-black for tops and black-white for bottoms. 2. Both real bodies extend the prevailing trend and are long. 3. The closes are identical. These patterns do not appear that often on the charts, but when they do, the sharp contrast between two long real bodies of differing colors touching each other after a prolonged trend should not be underestimated. Tower tops and bottoms. A tower top consists of a rally accumulating in a long white candlestick. This is then followed by a trading range in which the price gradually works its way higher, and then lower in a kind of reverse saucer format, as in figure 16.27. The pattern is completed with a long black day that opens roughly where the long white day closed, the two pillars of the tower. The tower bottom is exactly the opposite, as shown in figure 16.28. Ideally, the two pillars of the towers form at the same level, though this is not a prerequisite. Harami lines Yos. Chapter 6 offered the idea that trendline violations are followed by either a reversal or a temporary consolidation. Harami is similar to the consolidation trendline break-in that it indicates a loss of momentum. The main difference is that Harami are of much shorter duration and consist of 2 days price action. The Harami forms a real body that is sufficiently small so that it is engulfed by the prior day's long real body. If it is also a doji, it is called a Harami cross. These patterns often warn of an impending trend change, especially if they follow a series of strong white or black candlesticks. If we imagine a short-term rally where the buyers are in control, the Harami indicates a point of balance between both sides, as neither can push prices on a closing or opening basis beyond the limits of the previous candlestick. Sometimes this results in an actual price reversal, and at other times, a Harami is followed by a consolidation. Figures 16.29 and 16.30 show examples of a Harami where it is a reversal pattern. If, after a decline, the second candlestick forms around the lower area of the first, it is expected that a consolidation rather than a reversal will follow and vice versa for a Harami that develops after a rally. The color of the second candlestick is immaterial to the outcome. Rather, it's the idea of a balance between buyers and sellers that takes precedence. Chart 16.7 offers a nice example of a bullish Harami, where we see a sharp decline culminating in a long, black real body. Finally, there is a very small real body in contrast. Continuation formations. Rising and falling three methods. These formations are very similar in concept to a flag in bar charts, except that they take only a few days, not weeks, to develop. The rising method figure 16.31 is a bullish pattern and consists of a powerful white line followed by a series of 3 or 4 declining small black lines. These declining candles should be accompanied by a noticeable contraction in volume, which indicates that a very fine balance is developing between buyers and sellers. The final part of the pattern is a very strong white line that takes the price to a new closing high. If volume data are available, this final day should record a significant increase in activity. Bearish falling three methods figure 16.32 is exactly the opposite, except that volume characteristics are of no significance on the last day. Windows Coup. Japanese chartists refer to gaps as windows figures 16.33 and 16.34. Whereas gaps are said to be filled in traditional bar charts, windows are closed in candlestick charts. Windows, therefore, have the same technical implications as gaps. Chart 16.4 shows examples of where the opening and closing levels of windows acted as support and resistance for subsequent price action. Upside and downside gaps Tasuki. A Tasuki gap figure 16.34 occurs after an advance. The requirement is an upside white line gap, window, followed by a black line that does not close it. This type of pattern is usually followed by higher prices. However, if the gap is filled, the formation deteriorates into an upside gap with one crow and therefore loses its bullish portent. The downside gap is exactly the opposite and is featured in Figure 16.35, Candlestick Charts and Western Techniques. There is a tendency among many technicians to look at candlesticks in isolation. My preference, remembering the weight of the evidence approach discussed earlier, is to combine selected Western charting techniques with candlesticks. This involves, among other things, the inclusion of price patterns, trend lines, and oscillators into the analysis. Chart 16.8, for instance, shows a head and shoulders top for Microsoft that was completed in November 2000. Note that the sell-off during the right shoulder was an identical three-crow pattern. Later on, we see a double bottom. The rally from the second low consisted of a bullish belt hold, which in itself indicated that prices were headed higher. This bottom was also associated with a reverse head and shoulders in the relative strength indicator RSI. Finally, the head and shoulders top in the RSI was confirmed with a harami. One important question concerns where to draw the trend lines. Should they touch the wicks, real bodies, or a combination of both? The answer lies in our usual common sense approach. Since the opening and closing prices are generally more important than the high and low lines that exclusively touch, real bodies will generally be more significant than those only touching the wicks. However, a longer line that has been touched on more occasions that only touches the wicks will probably be more significant than a line that is relatively short and only touches two real bodies. Candlestick volume charts. Candlestick volume charts are the same as regular candlestick charts with one important difference. The width of the real bodies varies with the level of volume during that particular session. The greater the volume, the wider the real body and vice versa. This is shown in Figure 16.36. It can be a very useful way of presenting the data because the signals from the regular candlesticks are preserved, yet the width of the real bodies offers a quick and simple overview of the volume pattern. Examples of how bullish and bearish volume patterns would show up on candlestick volume charts are shown in Figures 16.37 and 16.38. Chart 16.9 shows a candlestick volume chart for Walmart, the world's largest retailer. Notice how the early November window following the bullish engulfing pattern was closed soon after. However, the very thin candlesticks that were involved in the retracement move indicated a lack of volume, which is precisely the type of thing that is required in a pullback of this nature. Heavy volume in such a situation would indicate selling pressure, as opposed to the situation here, where prices were clearly falling because of a lack of buying interest. The previous rally experienced a series of very thin candlesticks, which indicated that prices were rising on lower volume. This is opposite to the norm, where rising prices and volume are healthy. Therefore, the very thin candlesticks warned that the days of the rally were numbered. The late November, early December rally was associated with wider candlesticks, which was a good sign. However, as we reach the week of the 4th, the candlesticks move sideways but are very thin. This indicated that the balance between buyers and sellers was more evenly matched. The doji on the day of the high also reflects this even balance. This type of characteristic is often followed by a trend reversal, especially if volume picks up on the downside. That's precisely what happened here as the uptrend line is violated and the candlesticks thicken up. The long white line that developed at the very end of December looked good at the time since this candlestick was a pretty wide one, indicating heavy volume. However, there was no follow-through on the upside, which indicated that the long white line was a buying climax. This was confirmed first with the establishment of a harami on the subsequent day, and by a long black candlestick that retraced all of the ground gained by the long white line. Chart 16.10 shows an engulfing pattern for the March 2011 top for Broadvision. While there wasn't a lot of engulfing going on, the width of the second bar indicated huge motivation by sellers to get out. Later on, we see another wide bar which succeeded in violating support, as evidenced by the penetration of the horizontal trend line. The downtrend was resumed in late April by another long, wide, black real body. Summary. 1. Candlestick charts can be constructed only from data that include opening prices, and therefore, the technique is not one that can be applied to all markets. 2. Candlestick charts provide a unique visual effect that emphasizes certain market characteristics not easily identifiable from bar or closing charts. 3. Candlestick patterns form as reversal and continuation types. 4. Candlesticks can be used in conjunction with Western techniques in a weight of the evidence approach. 5. Adding volume to the formula often brings out actionable technical characteristics that are not always apparent when volume and price are plotted separately. Chapter 17. Point and figure charting. Point and figure charts versus bar charts. Point and figure charts differ from bar charts in two important ways. First, bar charts are plotted at specific time intervals regardless of whether there is any change in price. A new plot on a point and figure chart, on the other hand, is made only when the price changes by a given amount. Point and figure charts are only concerned with measuring price, whereas bar charts measure both price on the vertical axis and time on the horizontal axis. The second major difference is that bar charts record every change in price for the period they are measuring, but point and figure charts ignore all price movements that are smaller than a specified amount. For example, if a box is set at price movements of 5 points for the Dow Jones Industrial Average (GIA), only price changes in excess of 5 points will be recorded and smaller fluctuations will not appear. Construction of point and figure charts. Point and figure charts are constructed using combinations of X's and O's, known as boxes. The X shows that prices are moving up, the O that they are moving down. Once the amount of historical data to be plotted has been established, there are two important decisions to be made before a chart can be constructed. First, the size of each box must be determined. For individual stocks, it is common practice to use a L point unit or box for issues trading above $20.50 point unit for lower price stocks. However, for very long-term charts or for averages consisting of much higher numbers, it is more convenient to use 5, 10, or even 20-point boxes. As the box size is decreased, the detail of price movement graphically displayed is increased, and vice versa. In following the price action of a stock or market over many years, it is more convenient to use a relatively large box since small boxes will make the chart unduly large and unmanageable. Often, it is a good idea to maintain 2 or 3 different versions, just as daily, weekly, and monthly bar charts may be plotted. The second decision is whether to use a regular point and figure formula or to use a reversal chart, which should not be confused with a reversal pattern. The straight point and figure chart is plotted just as the data are recorded. If the price moves from 64 to 65, 5 X's will be plotted on a 20-cents point chart, as in Fig. 17.1. If the price reverses from 67 to 66, 5 O's will be posted. Reversal charts, on the other hand, follow a predetermined rule. A new series of X's or 0 cannot begin until prices have moved by a specified amount in the opposite direction to the prevailing trend. The use of the reversal technique therefore helps to reduce misleading or whipsaw signals and to greatly compress the size of the chart so that more data can be plotted. Figure 17.1b shows the same data plotted as a line chart. The construction of half-point, 5-point, or 10-point charts, or charts by any other measure, is identical to the previous method except that a new box can be posted only when the price has moved by the degree specified, that is, by half-point, 5 points, or 10 points, respectively. Since only price is recorded, it could take several days or even weeks before a new box is plotted. Hence, a common practice is to record dates either at the foot of the chart or in the boxes at the appropriate points. A combination of both date locations is used for longer-term charts. For example, the year is recorded at the bottom of the chart against the column that the first posting of that year was made for, and the beginning of each month is recorded in a box using the number of the month, 1 for January, 2 for February, and so on. The decision about unit size, and thus the degree of price change required to trigger a new column of O's or X's, is essentially based on personal judgment. It is determined by the price range and degree of volatility of the indicator, stock, or market under consideration. Reducing the size of the unit's figures increases the detail of the price movement portrayed. Making the unit larger expands the base of data that can be included, but this limits the number of fluctuations that can be illustrated. See Chart 17.1. Following a market with bar or line charts on a daily, weekly, or monthly basis corresponds to keeping several point and figure charts using various unit sizes. Point and figure charts are plotted on an arithmetic scale. If drawn on paper, they would have traditionally been constructed with 8, 10, or 12 squares to the inch. Occasionally, point and figure charts are plotted on a semi-logarithmic or ratio scale, though this is not the norm, because price objectives are calculated in a different way than those on regular charts with a time scale. Data published in the financial press covering the high, low, and close for specific stocks are not suitable for accurate point and figure charts. For example, if a $15 stock has an intraday price range of $1.50, it is impossible to know for point and figure purposes the actual course of the stock from 14.5 to 16. It could have risen from 14.5 to 16 in one move, which for a half-point chart would have been represented by 3 rising X's. Alternatively, it might have moved from 14.5 to 15.5, back to 14.5, and then to 16, which would have resulted in 2 X's, 2 O's, and then a column of 3 X's. The character of the rally has a very important bearing on the appearance of a point and figure chart. When dealing with data published in this form, it is better to use larger units so that intraday fluctuations do not distort the chart unduly. If more detail is required, the data should be purchased from a source that publishes intraday price movements. Charting packages featuring intraday data that have point and figure options are not affected by this problem. Accepted rules for plotting point and figure data where the actual prices on the tape are not known are as follows. If the opening price is closer to the high than the low, assume that the course of prices is open, high, low, and close. If the opening price is closer to the low, assume open, low, high, and close. If the opening price is also the high, assume open, high, low, and close. If the opening price is also the low, assume open, low, high, and close. If the opening price is the low and the closing price is the high, assume open, low, close, and high. If the opening price is the high for the day and the close is the lowest price, assume open, high, close, and low. Interpreting point and figure charts. General. Since point and figure charts do not include volume, moving averages (ms), or time, price action is the only element to be examined. In this respect, the basic principles of bar chart analysis are applied. There are certain disadvantages to using point and figure charts. For example, key reversal days, islands, gaps, and other such formations do not show up. On the other hand, if properly constructed, these charts represent all important price swings, even on an intraday basis. They effectively emphasize important support and resistance areas. For example, on a weekly bar chart, a single bar representing a weekly price action can take up only one line. However, if there was considerable volatility during the week in which support and resistance were each tested 3 or 4 times, this would most likely show up on a point and figure chart as a congestion area. As a result, the importance of these levels would be drawn to the attention of the technician, who would then be in a good position to interpret the significance of any breakout that might develop. Point and figure patterns are similar in nature to those of price patterns and may be of the continuation or reversal type. The most common ones are shown in Figure 17.2. Head and shoulders, H and S, and inverse H and S patterns, double tops and bottoms, and rounding tops and bottoms can easily be recognized as the point and figure equivalent of regular bar or close-only price formations, discussed previously. Most of the price patterns shown in Figure 17.2 are explained in Chapter 5. The count method. Chapter 5 pointed out that the minimum downside projection from an H and S top is derived by projecting the vertical distance from the top of the head to the neckline downward at the point of breakout. In point and figure charting, the width of the pattern is used to determine the measuring objective, which is again projected from the breakout point. No one to my knowledge has thus far satisfactorily explained why this principle appears to work. It seems to be based on the idea that lateral and vertical movements are proportional to each other on a point and figure chart. In other words, the more times a price has undergone price swings within 2 given levels, as dictated by the price pattern, the greater the ultimate move is likely to be once the breakout has taken place. On a point and figure chart, the dimensions of the consolidation or reversal pattern can be easily discerned by adding up the number of boxes and projecting the number downward or upward, depending on which way prices break out. The problem with the count method is that formations with irregular outlines can generate confusion about where the count should begin. The best approach is to select an important horizontal line in the formation, measure across it, and add or subtract the number of boxes in the line to or from the level of the line. Price projections for point and figure formations are by no means 100% accurate in all situations. In general, upside projections are likely to be exceeded in bull markets and downside projections surpassed in bear markets. Projections that are made counter to the prevailing trend have a tendency not to be achieved, such as a downside projection in a bull market. Chart 17.2 shows a couple of examples of the count method in action. Trend lines on point and figure charts. It is possible to construct trend lines on point and figure charts by joining a series of declining peaks. Uptrend lines are drawn by connecting a series of rising lows, and horizontal trend lines are created by joining identical support or resistance levels. The same principles of interpretation discussed in Chapter 8 apply to trend lines drawn on point and figure charts. The trend line takes its significance from a combination of length, the angle of descent or ascent, and the number of times it has been touched. Misleading or whipsaw signals occur occasionally. However, if a carefully chosen reversal amount is used as a filter in the construction of the chart, such whipsaws can be kept to a minimum. Another possibility would be to draw a parallel line one box above or below the actual trend line as a filter and use this as the signal to buy or sell. Although some timeliness is clearly lost with this type of approach, it does offer some protection from misleading price moves. Major technical principle. The fundamental difference between price projections based on point and figure charts and those based on bar or close-only charts is that the measuring formula of point and figure charts is derived from a horizontal rather than a vertical count. It is also possible to construct oscillators and plot them underneath point and figure charts. Since time is ignored in the point and figure charts, oscillators will appear differently than on regular charts where the time scale is plotted for each unit hour, day, week, and so on. An example using a 14-period relative strength indicator RSI is shown in Chart 17.3. Summary. Point and figure charts measure only one dimension price. Point and figure charts are constructed from columns of X's and O's, known as figures, which represent a specified, predetermined price movement. Point and figure charts often point up support-resistance zones better than bar charts because they emphasize the number of price swings that take place within a given congestion area. Point and figure charts are interpreted similarly to bar charts, the main exception being the measuring formula, which is achieved by the principle of the count. Chapter 18. Miscellaneous techniques for determining trends. We are going to start off with the concept of proportion, which is concerned with offering some ideas on the possible magnitude of a price move. I deliberately emphasize the word possible because there is no known technique that can consistently forecast magnitude or duration. These techniques should be used only as an indication of the probable extent of the move, not as the basis of an actual forecast. Perhaps the simplest way to explain the principle of proportion is to say that crowd psychology, as reflected in market prices, has a tendency to move in specific proportional amounts that have a habit of repeating, but unfortunately not in a predictable pattern. Thus, we could say that stock prices have a habit of doubling, and that may have happened 3 times in the last 20 years. However, there is no guarantee that they will do so in the current cycle. All we can do is observe when this happens and say that this is a good place to anticipate a reversal. Our decision, though, must be based on a consensus of indicators of which the principle of proportion is one. In this instance, the doubling would be an alert to look more closely at the balance of the evidence, proportion. The law of motion states that for every action, there is a reaction. Price trends in financial markets are really a reflection of changes in crowd psychology. The measuring implications of price patterns, trend lines, moving averages (MS), and envelopes, which were discussed earlier, are examples of proportion in practice. Support and resistance levels can help offer some ideas of just where a price trend may be temporarily halted or reversed. The principles of proportion can do the same thing, but they go much further. For example, when a security price is exploring new, all-time high ground, there is no indication of where a resistance level may occur because no transactions have taken place there. In such cases, the concept of proportion offers a clue to potential juncture points. Perhaps the best-known principle of proportion is the 50% rule. For instance, many bear markets as measured by the Dow Jones Industrial Average (GIA) have cut prices by half. For instance, the 1901 to 1903, 1907, 1919 to 1921, and 1937 to 1938 bear markets recorded declines of 46, 49, 47, and 50%, respectively. First leg of the 1929 to 1932 bear market ended in October 1929 at 195, just over half the September high. Sometimes, the halfway mark in an advance represents the point of balance, often giving a clue as to the ultimate extent of the move in question or, alternatively, indicating an important juncture point for the return move. Thus, between 1970 and 1973, the market advanced from 628 to 1,067. The halfway point in that rise was 848, or approximately the same level at which the first stage of the 1973 to 1974 bear market ended. By the same token, rising markets often find resistance after doubling from a low. The first rally from 40 to 81 in the 1932 to 1937 bull market was a double. The 50% mark falls halfway between the 1/3 and 2/3 retracement described in the discussion of Dow theory. These 1/3 and 2/3 proportions can be widely observed in all financial markets and also serve as support or resistance zones. Ratio scale charts are helpful in determining such points, since moves of identical proportion can easily be projected up and down. Chart 18.1 shows the 2000 to 2002 bear market. Note how the March 2001 rally retraced 50% of the bear market's first downleg. The next advance retraced a little more than 33% of the primary trend drop up to that point. Finally, you can see how the area of the 9/11 low proved to be resistance for the July-August 2002 advance. It is not possible to project which proportion will result from a specific move. However, these swings occur with sufficient consistency to offer possible reversal points at both peaks and troughs. If general market conditions and additional technical analysis of the price are consistent, there is a good chance that the projections based on this approach may prove accurate. Remember, technical analysis deals with probabilities, which means that forecasts solely based on this method should never be undertaken. If you are making a projection based on the rules of proportion, it is always a good idea to see whether the projection corresponds to a previous support or resistance point. If so, the odds will be much higher that this zone will represent a reversal point, or at least a temporary barrier. When a market is reaching new, all-time high ground, another possibility is to try to extend up trend lines. The point at which the line intersects with the projection using the rules of proportion may well represent the time and place of an important reversal. Experimentation will show that each market, stock, or commodity has a character of its own, some lending themselves more readily to this approach, others not at all. Chart 18.2, featuring Amazon, shows some retracement moves and does some 50% projections into new high territory. The full decline between 1999 and 2002, flagged by the thick arrow, sports a 0% because at that point, there is no retracement. The 50% mark halts the initial rally and forms support in 2008. The 150% level becomes a pivotal point, not as a resistance, but as support for subsequent declines. Major technical principle. Always use projections using the principles of proportion in conjunction with other indicators, speed resistance lines. This concept incorporates the 1/3 and 2/3 proportions, but instead of incorporating them as a base for a probable price objective, uses them in conjunction with the speed of an advance or a decline. This concept was developed by the late, great Edson Good, one of the finest technical minds of all time. During a downward reaction, a price may be expected to find support when it reaches a line that is advancing at either 2/3 or 1/3 of the rate of advance from the previous trough to the previous peak. This is illustrated in Figure 18.1. In examples A and B, A marks the trough and B the peak. The advance from A to B is 100 points and takes 100 days, so the speed of the advance is 1 point per day. A 1/3 speed resistance line will advance at 1/3 of that rate, that is, 1/3 of a point per day, and a 2/3 line will move at 2/3 of a point per day. A rally or decline is measured from the extreme intraday high or low and not the closing price. In order to construct a 1/3 speed resistance line from example A, it is necessary to add 33 points, i.e., 1/3 of the 100-point advance to the price at A, and plot this point directly under B. In this case, A is 100 points, and so a plot is made at 133 under B. This point is then joined to A, and the line extended to the right-hand portion of the graph. Similarly, the 2/3 line joins A and the 166 level on the same date as B. If the chart were plotted on a ratio scale, the task would be much easier. All that would be required would be a line joining A and B. This is shown in example B. The angle of ascent in this case, 30 degrees, would then be recorded. Two lines at 1/3, 10 degrees, and 2/3, 20 degrees of this angle are then drawn. Figure 18.2 illustrates the same process for a declining market. Once constructed, the speed resistance lines act as important support and resistance areas. More specifically, the application of these lines is based on the following rules. 1. Reaction following a rally will find support at the 2/3 speed resistance line. If this line is violated, the support should be found at the 1/3 speed resistance line. If the price falls below its 1/3 line, the probabilities indicate that the rising move has been completed and that it will decline to a new low, possibly below that upon which the speed resistance lines were based. 2. If the price holds at the 1/3 line, a resistance to a further advance may be expected at the 2/3 line. If it moves above the 2/3 line, a new high is likely to be recorded. 3. If the price violates its 1/3 line and then rallies again, it will find resistance to that rally at the 1/3 line. 4. Rules 1 through 3 apply in reverse for a declining market. Chart 18.3 shows the application of these rules in the marketplace, where A and B mark the points at which the lines are anchored, since these represent the first intermediate turning points in their respective bear and bull markets. Obviously, with the benefit of hindsight, it is easy to spot these turning points, but in reality, it is likely to be several weeks before they could be identified. Only then would it be possible to use the lines as potential support resistance levels. These are flagged with the small arrows. It would have been possible to come up with examples where the lines served more often as pivotal points, but the situation in Chart 18.3 is, unfortunately, more the rule than the exception. Fibonacci fans. Fibonacci fan lines are displayed by first drawing a line between two extreme points, a high and low vice versa in a declining market. An invisible vertical line is drawn through the second extreme point. 3 lines are then constructed from the first extreme point, the low passing through the invisible vertical line with their slopes at the Fibonacci levels, usually 38.2%, 50.0%, and 61.8%. These lines indicate potential areas of support and resistance. In Chart 18.4, the thick arrow joins the 2009 low in the S&P composite to its first intermediate high. Fibonacci fan lines at 38.2, 50, and 61.8% flag the 3 retracement levels, as at the vertical line. It is once again very important to emphasize that such pivotal points do not always appear as conveniently as in the chart. This emphasizes the idea already put forward that one should always use these techniques along with other indicators. They should never be used on their own to make a prediction because of their lack of reliability. Gann fans. Gann lines are named for the early 20th century commodity trader W.D. Gann. They come in 3 forms: Gann lines, fans, and grids. The most practical appears to be the fan approach. The concept and application are very similar to the speed resistance lines discussed earlier. Gann's idea was that specific geometric patterns and angles had unique characteristics for the prediction of price turning points. Essential to this approach was a balance between time and price. Thus, a 45-degree angle offered a perfect balance between price and time. That could only be achieved if the distance on the chart is the same for price and time, thus mandating an arithmetic scaling on the price axis. An example is shown in Chart 18.5. where the 9 Gann recommended angles are plotted. The following table reflects the rise-price increase over run-time difference. As way of explanation, 12 times 1 rise-run means that the price increases twice as fast compared to the time taken for a run of 1, and so forth. 1 times 8, 82.5 degrees. 1 times 4, 75 degrees. 1 times 3, 71.25 degrees. 1 times 2, 63.75 degrees. 1 times 1, 45 degrees. 2 times 1, 26.25 degrees. 3 times 1, 18.75 degrees. 4 times 1, 15 degrees. 8 times 1, 7.5 degrees. Chart 18.6 shows Gann fans. In this instance, the central line connects the high with the December low, and the rise-run proportions are the same. The center line reflects a 1 times 1. The upper line reflects an 8 times 1, and so forth. However, because the time and price distances are not the same, the lines are at different angles. The principles of interpretation are similar, in that it is assumed that when one line is penetrated, the price will find resistance at the next one if it is rising, or support in the case of a decline. Thus, the lines are continually reversing their support-resistance functions. See how the initial rally finds resistance at the 2 times 1 line. This line is subsequently penetrated on the way up, but acts as support for the next 2 reactions. Once again, there are far more exceptions than those reversal points that make up the rules. This means, of course, that Gann fans should be used as a place for anticipating a reversal, depending on what the other indicators are saying. Ichimoku cloud charts. The components. A relatively recent introduction to the Japanese technical arsenal is the Ichimoku cloud, also known as Ichimoku Kinko Hyo. Literally translated, it means at one glance balance bar chart. The cloud and its ancillary indicators provide trading signals through the ability to identify trend direction, as well as indicating potential support and resistance areas. Goichi Hosoda, the creator of this approach, argues that traders adopting it can immediately identify the trend and isolate potential signals within it. At first glance, the cloud approach appears complicated, almost intimidating, but when explained, its interpretation is relatively straightforward. The first thing to understand is that the relationship between the price and the cloud identifies basic uptrends and downtrends, and the relationship between 2 other indicators in the system generates short-term buy and sell signals under that context. Altogether, there are 5 moving parts to the system. They have been labeled in Chart 18.7. To simplify the explanation, we start off in Chart 18.8 by focusing on 2 indicators: the conversion line, also called the turning line, and the base line, also called the standard line. The conversion line is calculated as the midpoint of the 9-day high-low range. The default setting is 9 periods, and the formula would be 9-period high plus 9-period low, divided by 2. The baseline uses the same approach, but this time, the high over 26 periods is added to the low over that same period. The total is once again divided by 2. The Japanese term for the conversion line is Tenkan-sen, and for the baseline, it is Kijun-sen. The relationship between these 2 indicators forms the basis for short-term buy and sell signals, as well as the faster of the 2 cloud boundaries. Let's consider the cloud first, and then talk about the signals. The boundary derived from the conversion and baseline relationship is the cloud leading span A, or 1, Senku span A. This indicator is calculated by adding the value of the conversion line to that of the baseline and dividing by 2. It uses the word leading in its description because the result is plotted 26 periods into the future, as shown in Chart 18.9. The second cloud border, cloud leading span B or 2, Senku span B, is calculated by adding the 52-period high to the 52-period low and dividing by 2. The result is also plotted 26 periods in advance. In Chart 18.9, the 52-period high/low is calculated at point X, and the result is plotted at point Y. Since the high/low calculation returned a low number at X, cloud span B was plotted at quite a distance below the prevailing price at Y in late March 2012, because the actual price was much higher. The 5th moving part is the lagging line, which is the closing price shifted back 26 days. In the vast majority of situations, this series crosses the cloud after the price and represents a confirming signal that the trend has changed. The parameters outlined earlier are the recommended default ones, but there is no reason why others cannot be adopted. Also, the charts in this chapter feature daily data, but this approach can be applied to any time period. Since cloud span A, the thicker line, is derived from the shorter-term conversion and standard lines, it moves faster than span B, which relies on its construction from a longer 52-period average high-low relationship. Time frames. As with any other form of technical methodology, it's often a good idea to try to gain some understanding of the direction of the longer-term and more dominant trend than that being plotted. In this chapter, we have focused on daily charts and short-term and intermediate time frames. However, it also makes sense to explore the clouds being formed on the more dominant weekly and monthly charts. Traders with a very near-term horizon are encouraged to experiment with intraday time periods. Interpretation. The major trend. Since the cloud is constructed from price action, and this action is projected 26 days into the future, it indicates future support/resistance zones. An example is shown in Chart 18.10. It also shows that when the price is above the cloud acts as a natural support area and vice versa. It's also a characteristic that prices interact with the outer and inner edges of the cloud. The trend is up when the price is above the cloud and down when it is under it. It is considered neutral when the price is actually in the cloud. However, some analysts believe that the direction from which the price entered the cloud determines the direction of the trend. That would mean that if, for example, in a bull market the price drops into the cloud, the prevailing positive trend is still considered to be in force. Only when the price falls completely through the cloud is the trend deemed bearish. A compromise approach would say that when the price enters the cloud from above, this reduces the strength of the uptrend. At that time, the consensus of other indicators is then used to come to a meaningful conclusion as to the true state of the trend. The quality of the uptrend is strengthened when the leading span, a thick cloud border, is rising and is above the leading span B, thin cloud border. This situation produces a light cloud, normally green when colors are available on the chart. Conversely, a downtrend when the price is below the cloud is reinforced when the leading span A, normally green cloud line, is below the leading span B, normally red cloud line. Chart 18:11 just features the cloud. The bullish and bearish periods are indicated with the arrows, and at point A, the cloud span crosses above B for a stronger trend signal. At B1 and B2, the price slips into the cloud itself, and the trend is then defined as being flat. At just after B1, it moves back above the cloud again and is bullish. Chart 18.12 also flags bullish and bearish signals. Coming into the chart, the trend is bullish even though the price is declining. At A, it falls into the cloud, generating a neutral signal. As it rises through the thick span A, a bullish trend is again signaled. Unfortunately, the bottom building process results in another whipsaw at C. This is quickly resolved with a bullish signal at D. The trend remains positive all the way through until G. However, the A span cloud border thick line crosses below the B thin line at E. This tells us that upside momentum is dissipating and takes the positive trend down a notch. Note at E how the cloud changes temporarily from a light, normally green, to a dark, normally red highlight. We quickly see a regaining of momentum at F as the lines revert to their former status. After a false break to the downside at G and a subsequent small rally, a downtrend is signaled at H as the price slips below the lower boundary of the cloud. Chart 18.10 shows how the cloud served as a resistance level for the Microsoft price in 2012. When the cloud is extended, as it is in this chart, it is helpful in that it indicates future potential levels of support or resistance. Shorter-term signals. The relationship between the price and the conversion and baselines can be used to identify faster and more frequent signals. In conjunction with the idea that pro-trend signals are generally stronger than contra-trend signals, positive conversion/baseline crossovers are reinforced when prices are above the cloud, and the cloud has a light green shading. Bearish signals are reinforced when prices are below the cloud, and the cloud has a red, dark highlight. Conversely, signals that are counter to the existing trend are deemed weaker. Chart 18.13 features the iShares Germany ETF, the UG, with the clouds and lines, but excluding the lagging line to reduce the clutter. The period marked by the arrows on the left indicates when the price is below the cloud and therefore identifies when the trend is bearish. Thick conversion line crosses below the dashed baseline at point A, and the short-term system stays bearish until it crosses back above it at B. The period between B and C experienced ranging action, a trading characteristic not suitable for cloud analysis. Then at C we see another buy signal, but when it was generated, the price was slightly below the cloud, thereby flagging a bear trend. It would have been possible to enter the trade when the price crossed above the cloud because it had not moved much by this point and would not have been overbought. In this instance, a good profit would have been earned by the time the sell signal was triggered at D. Summary. 1. Price often moves in proportions, the most common of which are 1/2, 1/3, and 2/3. 2. Speed resistance lines, Fibonacci fans, and Gann fans offer potential support resistance pivotal points. 3. Ichimoku cloud charts offer both longer-term and short-term trend signals. 4. Future cloud action indicates potential support resistance areas. 5. Cloud charts can be plotted for any time frame from intraday to monthly. Chapter 19. Concept of relative strength. The concept. Relative strength RS is a technical concept that measures the relationship between two securities. It's important to note that relative strength, as we will be using it here, has nothing to do with Wells-Wilder's relative strength indicator, RSI, which is discussed in Chapter 14. The concept explained here is comparative relative strength, where the price of one security is divided by that of another. The result is then plotted as a continuous line whose trend is then analyzed. There are several ways in which relative strength can be used. 1. To compare one asset class to another in order to decide which one to buy, or to better understand an intermarket relationship. For example, we might compare gold to bonds to see which was in a rising trend. If the relationship was in an uptrend, it would indicate that on a price basis, gold was outperforming bonds and that it was, therefore, the preferred asset. It would also tell us that the market was anticipating an inflationary environment, since gold is largely purchased as an inflation hedge, whereas credit-worthy bonds typically do better in deflationary times. Another possibility might arise when a review of the technical position indicates that both the US and Japanese stock markets are in a bullish trend. Analyzing the trend of the relationship between them indicates which market is likely to outperform. 2. In commodity trading, a spread is a form of relative strength. A spread involves the relationship between one commodity and another, such as corn to hogs. Alternatively, a spread captures the relationship between a distant contract and a nearby one. In this instance, traders are attempting to discover relationships that have diverged from the norm and riding on the spread until the two contracts come back into line. Moreover, changes in these relationships also warn of emerging surplus or shortage conditions that help in supply-demand analysis relative to current and future conditions. 3. A currency is really a relative relationship. For example, there is no such thing as the US dollar in an external sense, because it consists of a number of cross rates, dollar-yen, euro-dollar, Canadian-US dollar, and so forth. Each currency is merely a relationship between itself and other currencies. 4. Sometimes the relative action between two entities reflects confidence and can be used for the purpose of analyzing the market itself. For example, we may find that the ratio between the technology and consumer staples sectors is falling. Technology reflects hot money that flows when confidence is high, and consumer staples are defensive issues that investors buy when they are apprehensive. Declining trend in this relationship would therefore reflect declining confidence and represent a bearish factor. This is a different type of relative relationship, which is covered in greater detail in Chapter 28. 5. The most common and important use of relative strength is to compare the price of a security to an index corresponding to its universe. The most common example would be a stock to a market average. For example, we might compare the performance of Facebook to the S&P composite. If the resultant RS line is rising, it would mean that Facebook was outperforming the market and vice versa. It is this concept of comparing an individual security to a market average that we will be concentrating on in this chapter. Please note that unless otherwise stated, all relative strength comparisons are calculated against the S&P composite. Major technical principle. Relative strength is a very powerful concept that facilitates individual stock selection. Construction of an RS line. An RS line is obtained by dividing the price of one item by another. The numerator is usually a stock, and the denominator a measurement of the market, for example, the Nasdaq or the S&P 500. Outside the US, it would be a stock price compared to a specific country average such as the DAX in Germany, the Nifty in India, and so forth. In later chapters, we will also look at the relative relationships between sectors and industry groups against the market, as this represents a shortcut method of stock selection. For example, it is quicker to study the RS lines for 12 sectors and then study the components of the selected area than to review 3,000 to 5,000 individual stocks. The relative strength concept can also be expanded to the commodity area. This is achieved by comparing the price of an individual commodity, such as corn, to a commodity index, such as the Thomson Reuters Commodity Research Board, CRB, composite, or the Dow Jones UBS Commodity Index. Our examples will focus on individual stocks relative to the market, but this and other concepts are equally acceptable. In this respect, Figure 19.1 shows the closing price of the stock in the upper panel and its RS in the lower one. When the line is rising, it means that the stock is outperforming the market. In this case, the denominator is the S&P composite, so a rising line means that the stock is outperforming the S&P. Later on, it continues to rally, but the RS line peaks out. This means that the stock is now underperforming the market. Another possibility might involve the comparison of an individual country stock or index to a global indicator, such as the Morgan Stanley World Stock Index. As long as the appropriate currency adjustments are made, the concepts are the same. The interpretation of relative trends is subject to exactly the same principles as the price itself. It is important to note that an RS indicator is just what the name implies, relative. A rising line does not mean that an item, such as a stock, is advancing in price, merely that it is outperforming the market or rising relative to the market average. For example, the market as measured by the S&P composite may have fallen by 20% and the stock by 10%. Both have lost value, but the RS line would be rising because the stock retreated less than the market. Major technical principle. Relative strength moves in trends, just like the absolute price. RS interpretation. Because the RS line moves in trends, it lends itself to trend reversal techniques such as price patterns, trend lines, and moving average MA crossovers. Momentum indicators may also be calculated from relative relationships. Relative trends can be interpreted in similar ways to trends in absolute prices. However, the introduction of relative analysis into the equation presents an additional dynamic. This arises from a comparison of the two series that often throws up subtle differences in much the same way as a comparison between the price and an oscillator. Since RS trends tend to experience more random noise than absolute price trends, we generally find that charts based on weekly and monthly data tend to be more reliable than those constructed from daily RS data. This same principle is true for the absolute price, but more so, I believe, for relative action. Positive and negative RS divergences. When both the price and the RS are rising, they are said to be in gear. Important trends usually begin with both series acting in concert, but eventually, the RS line fails to confirm new highs being set by the price itself. This type of situation indicates that the odds favor the stock beginning a period of underperformance against the market. However, weakness in RS is not an absolute sell signal, i.e., one indicating that the price itself will go down. It is merely a relative signal, i.e., one implying a switch from an issue that has started to become out of favor to one that is coming into favor. Quite often, though, a divergence or series of divergences between the price and RS represents an early warning sign of trouble, which is later confirmed by a trend reversal signal in the price itself. In Figure 19.2, the two are in gear at the start, but later on, the RS line diverges negatively with the price on 3 occasions. Finally, the price itself completes a top and declines. The opposite set of circumstances holds true in a declining market, in which an improvement in RS ahead of price is regarded as a positive sign. An example is shown in Figure 19.3. This time, the confirmation comes from a trendline break in the price. Trend reversal techniques. 1. Moving average crossovers. Sometimes it's a good idea to run a moving average through the price using the crossovers as legitimate signals of a change in trend. It's also possible to do the same thing for a relative strength line. But because the RS line tends to be much more volatile, this technique often proves unprofitable because of the numerous whipsaws that are generated. This is especially true for short-term trends, but even long-term moving averages, such as a 40-week simple or 65-week exponential, often result in more whipsaw signals than we might like. Figure 19.4 offers an alternative. It involves plotting two moving averages, a short-term and a longer-term average, using the crossovers for signaling trend reversals. This approach definitely eliminates whipsaws, but the trade-off is that several signals are less timely. An example is shown in Chart 19.1 for General Motors. Note the numerous whipsaws for the 65-week exponential moving average, EMA, being flagged by the ellipse. Chart 19.2 shows an alternative where the 65-week EMA is used with its 10-week EMA as a method of signaling trend changes. Note that nearly all of the 1996-1998 whipsaws have been eliminated. We are still left with a couple, but the 1996-1998 pounding is totally avoided as the 65-week red line remains below the solid blue line during the whole period. It is a good idea when you have settled on a time span that makes sense to take a look back historically to make sure it has worked consistently in the past. This should include as much historical data as possible so that its performance during a variety of market conditions can be assessed. For example, a chart plotted with weekly data should ideally cover at least 8 years, 2 complete cycles of data. 2. Trendline violations. In my view, a better alternative to the moving average approach is to construct trend lines against the relative strength line. The concept is to construct a trend line for the RS line, and when that is violated to look around for a legitimate trend reversal signal in the price itself. In that way, we can see that the price is responding to the relative strength or weakness. Figure 19.5 shows an example of a reversal from an uptrend to a downtrend. Figure 19.6 shows that this is also a useful way to identify buy candidates. The first thing to do is wait for a violation of the RS line. Then, when the price also confirms with a trend reversal signal, you can take some action. These joint violations don't occur that often, but when they do, it's usually a signal of an important reversal. In this case, the strength of the signal has been enhanced because it was preceded by a positive divergence. The divergence did not represent a signal to buy, but it did set the scene for some positive action later on by indicating that the technical position is improving. Incidentally, the confirmation by the absolute price does not have to be a trendline break. It could be a price pattern completion, a reliable, and I emphasize the word reliable, moving average crossover, or even a reversal to a series of rising peaks and troughs. Remember at all times that the size of the new trend will depend principally on the time frame being charted and the length of the lines. Intraday breaks, for example, reflect small trends and will have nowhere near the significance of trendline violations on the monthly charts. 3. Price patterns. Price patterns can also be employed to analyze trends in relative strength. In Figure 19.7, the RS line completed a head and shoulders top. This certainly indicates that the RS trend has reversed and provides enough evidence to justify a switch from this stock in favor of one where the RS trend was emerging in a positive way. However, it does not signal that the price itself is going to decline, though in many instances that will prove to be the case. In this particular example, the absolute trend reversal is signaled when the short-term low flagged by the small horizontal trend line is violated, because this confirms that the series of rising bottoms and tops has now been reversed. Note that even though the price subsequently rallies back through the line, this does nothing to reverse the peak-trough progression to the upside, so the trend is still regarded as negative. Figure 19.8 features a reversal from a downtrend to an uptrend. First, the RS line diverges positively with the price. This is our initial indication that both trends may be about to reverse. And the RS line traces out a rectangle and breaks to the upside, later to be followed by the price completing a broadening formation with a flattish top. Divergences and trend signals. Sometimes a study of the relationship between the price and RS line can be quite revealing. Chart 19.3, for example, featuring Stanley Works, shows the price reaching a new high in April 2006, but the RS line fails to confirm. This provided some advance warning that the technical structure was not as positive under the hood. When both trend lines were violated later on, this confirmed the weakness and lower prices ensued. Later on, the price began to rally and everything was in gear until June 2007. This was the warning that when both trend lines were penetrated that price weakness would continue. Chart 19.4 shows another RS example. This time, it was the Turkish Akbank versus the Turkish index. The start of 2005, the divergence between the RS and absolute price was quite serious, as the RS line was falling quickly. It violated its trend line early on, but when the price followed suit, a very nasty decline followed. Quite often, when we see a discrepancy as large as this, the weakening RS line is offering a loud warning that despite what we see on the surface, rising absolute prices, the technical picture is really quite weak. The price is being dragged up by the market, and when it finally turns, the deteriorating relative strength chickens come home to roost. Later on, we see a positive RS divergence as the RS line bottomed in early March, but the subsequent late March higher low was not confirmed by the price. Later, both series violated downtrend lines and a rally was confirmed. Long-term relative strength. Chart 19.5 features a monthly close of the S&P domestic oil relative strength line. This is a very long-term chart that encompasses much of the 20th century. It is useful in that it demonstrates that the RS line lends itself to price pattern and trendline construction. These formations are not completed very often, but they are usually followed by a relative price move that lasts for many years. It's important to bear this in mind because most of the patterns look small on the chart, but actually extend over considerable periods of time. Their completion, therefore, signals a change in the environment that typically lasts for many years, even decades. For example, it traces out a 12-year reverse head and shoulders top in the 1970s. A break of this magnitude signals a change in sentiment for a very long time. Indeed, a huge rally took the RS line to its secular peak in 1980. Note the fact that the oil index itself experienced a substantial rally between 1980 and the end of the century. This means that oils would have been a good place to invest in this 20-year period. Hardly, because the persistent decline in the RS line indicated that they were consistent underperformers. Only in the next decade did the relative action come into its own as it broke out from a triangle base, resulting in a rally by both series. In 2008, this strong relative rally was halted as the 2003 to 2008 uptrend line was violated. Obviously, we would not make a practice of studying these long-term charts every week or so, but say, once a quarter, it does make sense to review the bigger picture to see whether any major trends might be emerging. Major technical principle. It is the longer-term trends that dominate the characteristics of their shorter-term brethren. On a more regular basis, we would look at monthly charts covering shorter periods of time, later moving down to the weekly and daily ones. Individual stocks and relative strength analysis. Chart 19.6 features a daily chart of Hewlett-Packard. It starts off in early 2005 with the simultaneous completion of two inverse head and shoulder patterns. In 2007 and some of 2008, the absolute price traces out a head and shoulders top, and at the breakdown point the RS line is close to a high. The actual price starts to fall like a stone, but the RS line continues its upward march. This shows that Hewlett-Packard was a relatively safe place to be. Its recovery bounce into 2010 continued to indicate that the price had weathered the storm and was likely headed higher. However, both series violated trend lines at B. The RS trend line was far more significant because it was much longer 6 years and had been touched or approached on 8 occasions. This indeed was a serious break, and anyone who had confidence in the stock because it had weathered the previous bear market quite well should have paid attention to this very serious break. In the following 3 years, the bottom literally fell out of the market. Even during the 2 small rallies at C and D, the relative performance continued to deteriorate. Major technical principle. It's always better to avoid a stock when it tries to rally during a downtrend, but the RS line does not. On the other hand, an improving RS line is often an early clue that a turn may be at hand. In such cases, the clincher is the eventual confirmation by the price. Relative strength and momentum. Long-term trends. Since classic trend-determining techniques can be applied to RS lines, it is a small step to expand the analysis to embrace momentum indicators derived from relative strength lines. While it is certainly practical to apply oscillators to short-term momentum derived from RS lines, by far, the best use of momentum in relative work, I believe, is to use oscillators based on long-term spans, especially if they have been carefully smoothed to limit unwanted fluctuations. Chart 19.7 features the relative strength line of the Dow Jones Oil and Gas Sector ETF together with a long-term no sure thing, KSD, of relative strength. The waves against the RS line reflect those in the KSD. Peaks in the KSD roughly correspond with its peaks and troughs. As we shall learn in a later chapter on group rotation, see Chapter 22, RS lines are far more cyclical in their patterns than absolute prices. This makes the use of smoothed long-term oscillators, such as the KSD, far more accurate in their reflection of the primary trend. Remember, absolute prices can be subject to strong linear trends, which means that even the best designed smoothed long-term momentum indicator will offer premature buy and sell signals. We cannot say this will never happen with a long-term momentum indicator constructed from relative action, but it is certainly a lot less likely. The principal objective is to identify a security when its long-term KSD is below 0 and starting to poke above its 26-week EMA. Incidentally, The average plotted against the RS line itself is a 65-week EMA. Note that even with a substantial time span such as this, there were still numerous whipsaws, especially after the late 2008 bottom. This is one of the reasons why I prefer to use trendline violations of the RS line in conjunction with long-term RSKSD reversals. They are certainly not perfect, but tend to be relatively more reliable, as demonstrated by 3 of them in this chart. This example used a KSD, but it is possible to substitute any smooth long-term momentum indicator. The KSD just happens to be my preference. Alternatives could be a stochastic, a moving average convergence divergence MACD, or other trend deviation indicator. The basic idea is to use one that closely resembles the primary up and down waves, yet turns reasonably close to the turning points. When experimenting, always try for consistency over a number of securities in different time periods. Never aim for perfection because it just doesn't exist. Once the direction and maturity of the long-term trend of the RS has been established, it is then time to move to the shorter-term charts. Short-term trends. Chart 19.8 features the relative action of the spider metal and mining ETF symbol XME together with 2 rates of change ROCs. The 10-day series registered a post-1989 limit of my database high. The 45-day ROC also traced out an extreme swing and broke out from a small base a little later on. Price eventually confirmed with the completion of a small platform, double bottom formation. In a strict sense, this was not a mega overbought because the price declined for only 6 months and did not reach my minimum benchmark of 9 months. However, the speed of the decline and the fact that it was a post-1989 overbought condition that was confirmed by the price qualifies it as one in my poetic license book. Chart 19.9 features the relative action of Abbott Labs in the top panel, followed by a 14-day RSI of the RS line, and in the lower panel, and MACD of the RS line. It is fairly evident by looking at the chart that there are 2 main environments, a bear market between the end of 1999 and the start of 2000. This is then followed by a bull move. Now take a closer look at the MACD. During the bear market, it fails to reach an overbought condition, yet oversold readings fail to signal rallies. The opposite is true during the bull phase. This is typical of oscillators since they change their characteristics in primary bull markets. Just like birds in the northern hemisphere, they migrate to the south during the winter, or the bear market, and to the north in the summer, or the bull market. Whenever you can spot a situation where an oversold oscillator fails to trigger much in the way of a rally, this represents a tip that the prevailing trend may be bearish. It doesn't happen every time, of course, but in most cases, this rule will work out. In this case, the failure of the January 1999 MACD oversold condition to generate a rally and its failure to register an overbought reading a little bit later pointed to a bear market environment. A sign that a bull market was starting did not come when the MACD reached an overbought reading, which, after all, is still possible in a bear market. Instead, it came when the May decline in the oscillator did not fall back to an oversold reading, but was held just above 0. Such action indicated that the underlying character of the MACD had probably changed for the better. Chart 19.10 shows an analysis of the relative action in greater detail, starting with the October top. Signs of weakness started to appear as both the RSI and the MACD of relative strength violated uptrend lines. This was then confirmed by the RS line itself violating one of its own. This joint action was not important enough to signal a bear market, but it definitely indicated that the uptrend would likely be stalled for several months. In effect, Abbott Labs was probably underperforming the market during that period. If you look carefully, you can see that the RSI trendline was, in fact, the neckline of a head and shoulders top. As we move on, the price action becomes progressively disappointing. The January oversold condition merely triggers a sideways trading range after which the relative downtrend is resumed. Also, look at the 3 down trendline breaks. They should have been followed by a good rally, but they were not. This type of action is often indicative of a bear market. Chart 19.11 shows the same period but also includes the actual price. The dashed up trend line marks the approximate point where the relative sell signal was triggered, but note that the absolute price continued to extend its rally. It then diverged negatively with the RS line, indicating underlying technical weakness. However, it remained above its solid uptrend line until January 1999. If the sell signals in the RS line that had developed previously were not sufficient evidence to justify liquidation, the violation of this trend line in the absolute price certainly was. Chart 19.12 shows a close-up of the bullish period featured in Chart 19.9. Remember, coming into this period, the RS line had been in a strong bear market where the momentum indicators had been triggering false signals. However, in March 2000, some positive action by both momentum series starts to develop, since they barely fell below the equilibrium level at the time the RS line was reaching its second low in the top panel. Also, the MACD moved above its previous high, indicating a probable change in character more suitable for a bull than a bear market. Finally, the RS line confirmed by breaking above the horizontal line, marking the top of a double bottom formation. At the same time, it confirmed that a series of rising peaks and troughs was now underway. Throughout the bear market, each rally high was lower than its predecessor, likewise with the bottoms. Spreads. RS is widely used in the futures markets under the heading spread trading, in which market participants try to take advantage of market distortions. These discrepancies arise because of unusual fundamental developments that temporarily affect normal relationships. Spreads are often calculated by subtracting the numerator from the denominator rather than dividing. I prefer the division method because it presents the idea of proportionality. However, if a spread is calculated over a relatively short period, for example, less than 6 months, it is not important whether subtraction or division is used. Spread relationships arise because of 6 principal factors: product relationships, such as soybeans versus soybean oil or meal, oil versus gasoline or heating oil; usage, such as hogs, cattle, or broilers to corn; substitutes, such as wheat versus corn or cattle versus hogs; geographic factors, such as copper in London versus copper in New York, or sugar in Canada versus sugar in New York; carrying cost, such as when a specific delivery month is out of line with the rest; quality spreads, such as T-bills versus Eurodollars or S&P versus value line. Some of these relative relationships, such as London versus New York copper, really represent arbitrage activity and are not suitable for the individual investor or trader. On the other hand, the so-called TED spread, which measures the relationship between high-quality T-bills and lower-quality Eurodollars, is a popular trading vehicle. In some cases, spreads move to what was previously an extreme and proceed to an even greater distortion. For this reason, it is always important to wait for some kind of trend reversal signal before taking a position. While the risk associated with such transactions is by no means eliminated, it will certainly be reduced. Other relationships between various asset categories are further analyzed in subsequent chapters. These relationships may be used for different purposes, but all are subject to trend reversals that can be identified by the techniques already described. Summary: 1. Comparative relative strength compares one security with another. The result is plotted as a continuous line. 2. The most common application is to compare a stock or sector with a market average. When the line is rising, it means that the security in question is outperforming the market and vice versa. 3. Divergences between the absolute price and relative strength warn of latent strengths and weaknesses and can help in identifying potential trend reversals. 4. Relative strength moves in trends. Any legitimate trend determining technique can be applied to a relative line. 5. Joint trend line breaks in both the absolute price and the RS line usually result in reliable trend reversal signals. 6. One of the most useful techniques for analyzing the primary trend of relative action is the use of smooth long-term oscillators, especially the KSD. Chapter 20. Putting the indicators together, the DJ Transports 1990 to 2001. It is now time to combine the indicators that we have covered so far into an analysis of the long-term picture. For this purpose, I've chosen the Dow Jones Transportation Average between 1990 and 2001. Chart 20.1 shows the average together with its 9-month EMA. This was one of the best testing averages derived by optimizing from 1931 through to the year 2000. The upward and downward pointing arrows indicate the principal turning points in this period. The 1990 bottom was not an easy one to recognize because the average virtually reversed on a dime. Chart 20.2 shows that the 18-month rate of change, ROC, violated a sharp downtrend line just before the price. The relative strength, RS line, in the center panel of chart 20.3 actually broke its bear market trend line ahead of the absolute price. This indicated that the DJ transports were likely to outperform the market during the early stages of the new bull market. The vertical line in chart 20.4 shows that this was one of the few occasions in which all three oscillators were simultaneously oversold. This chart also offered the strongest buy signal because the downtrend line for the price was violated at approximately the same time as the 65-week exponential moving average, EMA. Also, the 39-week CMO completed a base. By February 1991, several positive signs had therefore developed, all of which indicated that downside momentum had probably dissipated sufficiently to allow the long-term no-sure-things KSDs to reverse to the upside. The next major event was the intermediate peak in 1992. The average briefly crossed below its 12-month chart 20.2 and 65-week EMAs, chart 20.3, and the long-term KSD also triggered a negative whipsaw signal. These events could certainly have justified the conclusion that the transports had begun a bear market. However, once the average and the long-term KSD chart 20.2 had crossed back above their respective moving averages, there was little reason to maintain a bearish stance. Unfortunately, this whipsaw-type activity occasionally develops from an intermediate correction. Under such circumstances, it is important to keep an open mind on the indicators. In this case, chart 20.4 shows that the 20-week Shand Momentum Oscillator, CMO, broke out from a base, and several downtrend lines were broken, so there was plenty of evidence that the tide had turned. The top of the bull market developed 2 years later in early 1994. Signs of a major top were quite widespread. In chart 20.2, the transports simultaneously violated a 4-year uptrend line and the 12-month EMA. The KSD gave a decisive sell signal, and the 18-month ROC completed a head and shoulders H&S top. In the whole 11 years covered by the chart, there were only 2 completed chart patterns for this indicator, so the early 1994 breakdown was very significant. Chart 20.4 was equally significant in its bearish entrails. The 39 and 52-week CMOs diverged negatively with the price, and both series completed a top or experienced a major trendline violation. At the peak itself, the 20-week CMO was actually overbought. The chart shows that, except for the strongest of up or downtrends, the overbought and oversold conditions were often associated with intermediate-type reversals. Later in the year, something more ominous started to happen, and this was a trendline break in the RS line. For the first time since the bull market in RS began, the long-term RS, KSD, shown in chart 20.3, triggered a decisive sell signal. Although it was not apparent at this point, the transports had begun a long period of underperformance. Because the ensuing bear market was relatively mild, the bottom in early 1995 was only signaled on the weekly charts. Once again, chart 20.4 holds the key, as the downtrend line in the 52-week CMO was violated and a base in the 20-week series completed. The transports themselves more or less simultaneously broke above their bear market downtrend line and 65-week EMA. The long-term KSD in chart 20.3 also turned positive around the same time. The average remained above its 65-week EMA for the next 4 years, and the series of rising peaks and troughs continued. Then, some extremely serious trend breaks developed. First, the average itself crossed below its 12-month EMA and violated its bull market trendline chart 20.2. The KSD also triggered a sell signal, and the 18-month ROC completed a top. Chart 20.5 shows that the transports also completed and broke down from an upward-sloping H&S top and crossed below its 65-week EMA more or less at the same time. Notice how the 39 and 52-week CMOs were actually below zero at the time the average was forming the right shoulder. This distinct lack of upside momentum was a very bearish sign. Not surprisingly, the transports experienced a pretty sharp decline into the fall of 1998. The most serious technical damage of all came from chart 20.3 in the form of a major breakdown in the RS line below a 6-year support trend line. This happened as the absolute price was crossing below its 65-week EMA. Trouble on the RS front had been signaled long before this, because it had utterly and completely failed to confirm the bull market in the absolute price. By the time of the 1998 peak in the transports themselves, the RS line had experienced a major negative divergence. When the RS line moved to a new post-1993 low at the end of 1996, this should have been warning enough that there were far better places for exposure than transportation stocks. The 1998 bottom, like that of 1990, was an elusive affair, but more so because the turn was so sharp. All three CMOs in chart 20.5 violated downtrend lines, but the average itself did not cross above its average until it had rallied a long way from the bottom. No downtrend lines could be drawn against the price, so it was not really possible to build a timely and convincing bullish case. In cases where the evidence of a trend reversal is incomplete, it is always better to avoid the security in question. In any event, the overriding factor should have been the early 1998 breakdown in the RS line, as this set the scene for the next several years of trading action. Indeed, as it turned out, the 1998 to 1999 advance was really an above-average reflex rally, since all the price was able to do was to rally back to resistance in the form of its 1998 high and the extended bull market trend line. During this whole period, the KSD failed to give a buy signal, and the RS line in chart 20.3 never crossed back above its 65-week EMA. Finally, the average violated its 1990 to 2000 uptrend line at the start of the new century. This was not a great trend line, for, although it was quite long, it had only been touched on 2 occasions and was not therefore a great reflection of the underlying trend. However, it did result in a sideways trading range over the ensuing 2 years. The critical point after this would be the trend line joining a series of lows between 1996 and 2001. A break below it, notwithstanding other evidence, would be a serious technical blow. Summary. This has been a brief account of the technical position of the transports between 1990 and 2000. Although it was not possible to include too many indicators, it has enabled us to describe how trend indicators for price, momentum, and RS can be combined to help identify major turning points.
Thank you for listening to this audiobook. We truly appreciate your time and support. If you enjoyed the content, don't forget to subscribe to the channel, like this video, and share it with others who may also benefit from it. Your support helps us bring more great audiobooks and learning resources to you.